today is BBCAF Inc., case number 180113333.
Good morning, everyone, and welcome to the Office of Tax Appeals, affectionately known as the OTA. My name is Jeffrey Margolis, and I am the lead judge in today's hearing. With me are my co-panelists Tommy Young and Kenny Gass. Although I am the lead judge for purposes of running today's hearing, my co-panelists all will have an equal say in how we decide this case. Before we go on the record with our court reporter, Mr. Peter Petty, let me briefly review what the OTA does in today's hearing process. The OTA is an agency that's independent from the FTB. We provide a forum in which taxpayers can have their disputes with California tax agencies resolved fairly and economically consistent with California law. Our independence from the taxing agency also means that we don't have access to documents or statements that the taxpayers may have provided to the FTB, or the FTB may have provided to the taxpayers, unless those documents were attached to your briefs or provided to us today, through witnesses or otherwise. If at any time you are confused about the process, please feel free to ask me to stop and explain. This is a complicated case, and I want to give both sides every opportunity to present your positions. When we go on the record, I will ask the parties and the representatives to introduce themselves. Then I will summarize the issues the parties have asked us to decide. But before we go on the record, let me make sure we are still in agreement on the issues that you've asked us to decide, so I can accurately state them when we do go on the record. Based on our discussions at the pre-hearing conference, as I understand it, the issues you've asked the OTA to decide are as follows. Whether the FTB's interest expense adjustment constitutes a new matter such that OTA should prohibit the FTB from raising it, or alternatively that FTB should bear the burden of proof on its determination. Secondly, whether the interest expenses deducted by appellant must be allocated between its in-state and out-of-state non-unitary investments, and if so, whether those allocable to the out-of-state investments should be disallowed. And if an allocation is required, how that allocation should be made. And finally, if there are any deficiencies determined in this matter, should interest be abated or suspended for any period of time. That's what I see the issues that we're trying to deal with here. Is that correct, Mr. Kaplan?
That is correct.
Ms. Iskander?
It is correct.
Okay, great. And after we go on the record and restate the issues, I also want to see if we can stipulate any facts. In our pre-hearing conferences, you seem to agree on most of the facts, but there's a few that I wanted to see if we can tie down. One such stipulation might be that BBCAF is commercially domiciled in California. I think that's agreed.
We cannot agree to that. We have not discussed this, and they do not have offices in the United States, and they are an by corporation. So we're not sure why would they be commercially domiciled.
Okay. That's fine then. So we don't have a stipulation on that. I'd like to see, do we have, I've asked the parties to review the computations that Mr. Kaplan has provided to see whether or not they accurately reflect the FTB's position. Do you stipulate that his computations are correctly reflect your position, or do you want to get into that through the testimony of your witness?
We provided Exhibit I last night, and we just supplied you with one which reflect the correct calculations.
Okay, fine.
There's some differences.
Okay. We talked about these different allocation methods, and one of the allocation methods that we brought up at the pre-hearing conference was an allocation method based upon the cost of the in-state properties relative to the cost of total properties acquired. And apparently at the pre-hearing conference you said Mr. Iskander, you said you had done an allocation, you'd done an analysis which determined that 28% was allocable to the in-state properties. I know that's not your position here, but do you agree that that would be the percentage if an allocation was based upon the cost of the properties?
If we were to make an allocation based on original cost, that is available during those years, then about 27.6% of the amount was invested
Okay.
in California.
Yes, I think.
But it should also be, and it's on the record as far as supplemental brief, is that a California property was purchased before any loans. So, because we found it only in supplemental brief, I don't know if the original quote would be a good idea.
Okay.
I didn't hear that last sentence.
Because your supplemental brief stated that California property was purchased prior to the first loan.
Mr. Kaplan, do you agree that if there was an allocation based on the original cost, that 27.6% would be the ratio of in-state to total property?
Yes.
Okay, great. And we had one last minute document that was submitted today is FTB's exhibit. This would be I believe, is that
Yes.
correct?
I emailed it yesterday, at the end of the day, and we also supplied back today.
Okay. Are there any other additional documents that we need to mark and admit today, that either party anticipates?
We have, some documents, but we don't intend to make them an exhibit, it's only for illustration purposes if the question as to those, issues arises.
Okay, that's fine. So we've gone over the issues, the stipulations. Let's just go over the exhibits before we go on the record, because that can get a little bit messy. See whether or not there's any objections to the exhibits. You've received the exhibit log that I emailed to you about a week or so ago. Let's go over the appellant's exhibits. And I know that at the pre-hearing conference I said some of these exhibits would be joint exhibits. In this listing, I basically just identified them as appellants or respondents based upon who provided them to the OTA. So Exhibit 1 are the MPAs for the years at issue. Does either party have any objection to those being admitted?
No.
No. Exhibit 2, the notices of action, any objections?
No.
No. Exhibit 3, tax due is calculated by FTB with corrected NOLs and non-California gains. Do either party have an objection to that? Do you, Mr.
I
Conlon?
certainly don't object that those reflect the FTB's computations.
Okay. Mr. Skinner?
I believe that exhibit has the original cost is 28%.
And that number should be 27.6?
Well, yeah, because that was not circulated, this was circulated only for illustration purposes with the taxpayer, it is not our position.
Okay. Okay.
So, I mean, we can have it just for the matter of discussion, but it is not our position.
Okay, that'll be admitted for discussion purposes. And with the note that the 28% should really be 27.6%.
If the original quote, but there's also, as I said, there's a California property that was not purchased with the loans
Correct.
prior to the
Okay.
loan. So if we were to account for that, the percentage would be smaller.
Okay. And then there's Mr. Kaplan's exhibit 4, which is another schedule. Is there objection to exhibit 4 being admitted for discussion purposes? No? Okay, great. Then there's, I think, about 279 pages of
Well, there's
excerpts.
exhibit 5 also.
There's exhibit 5 is the cover email from Mr. Kaplan with their documentary submission. Is there an objection to that being admitted?
Yes, there is, because we believe that that contains argument and not actual evidence. The evidence that that document reflects is in other exhibits, but we would object to 5 itself because it's argument.
Okay. Let me take
And we can explain that on the record.
Let me just see what exhibit 5 actually says in terms of what it might be argument. Mr. Kaplan, maybe you can get whatever information you need from this exhibit in through Ms. Freeman's testimony. Is that possible, or I'm not sure if it's that.
I do not have that exhibit with me. It wasn't something that
I have a copy of it. Mr. Kaplan, you may approach the bench.
Thank you.
You can hold on to that for the proceeding. I have it on my computer.
Thank you.
We'll take a moment and see if there's anything you need to, maybe the FTP could stipulate to certain facts if necessary.
What was the question again?
Is there, you have to be objects to this as containing argument. Are there any, is there any reason you need to have any of these factual allegations in here, or that these are already in other documents that are likely to be admitted?
I don't believe so. I'm looking to try to find where there might be argument made in this, but
Mr. Cornez, what arguments are you objecting to specifically in this document?
This exhibit here lists, goes into details of what an interest income consisted of. We have not had a chance to discuss it during the appeal discussions in preparation to this hearing. And although respondent asked several times to explain what the interest income is and how it was earned, we have never gotten a solid answer other than it was from short-term investments. So we did not, we simply don't have, we cannot stipulate it because we don't know how, we have not had a chance or opportunity to verify that this is so. So we can't stipulate to the fact as stated.
Okay, I think that that the panel is going through some of these documents, and I think that he's saying two things here. I think he's saying that the interest income, that some of the interest income reported was earned by the taxpayer itself as opposed to the pass-through entities. And then there's the allegation that it's short-term investments. Are you just objecting to the fact that it's short-term investments, or you're objecting to the fact that when he says that some of the interest was earned by the parent company itself versus K1s?
We don't know. We don't know whether or not, okay, first of all, this is contradictory to their opening brief and the stipulation made in the opening brief. So we don't know whether or not this statement, the statements that they make are actually true or not. We have not, this issue was not audited, it was not discussed. So for the first time, we've seen this description in this exhibit. So I don't know whether or not it's appropriate to have to, for us to stipulate to it. We can't. And whether or not you want to admit it as exhibit, we can deal with it. But you know, our objection is that it's basically a supplemental briefing. You know, it's more than just a cover letter. It's a supplemental briefing.
Okay.
And the briefing has been closed with the, you know, a year ago.
Your Honor, maybe we can short circuit this. It sounds to me, as you alluded to, that the problem is with my statement that the interest was earned by the taxpayer through his own short-term investments. The problem is Franchise Tax Board has not audited the source of that income. We're more than happy to strike the through its own short-term investments from this document. We don't think the source is particularly relevant.
Well, it is somewhat relevant to your interest offset computations. I think that this information, why don't we admit this as additional argument, not as evidence. I think that to a large extent, these figures can be determined by looking at the K1s.
Yeah, I was gonna say too, in the FTB's recent exhibit, they're including these interest income numbers.
We are only doing that because we were supposed to verify taxpayers' schedules, taxpayers' exhibits. So we didn't do it because we wanted to, we did it as our verification of their schedules. We're not disputing that there is an interest income entry on the return. We just are saying that no matter how many times we asked to discuss the interest income and how it's generated and who generates that, given the fact that the felon does not have employees or offices, we were not given that answer. So for us, it appears as if it's a supplemental briefing without much substantiation. So if you want to admit it for discussion purposes, we're okay with that. If you have to admit it, we can deal with that too, but I feel that we have to state our understanding of whether or not it should be admitted or not.
Perhaps we could get an explanation of why the respondent feels that characterization or the source of that interest income is important to the issue before this panel.
And we will get to that during the argument.
Okay, let's leave it at that for now.
That's fine.
I'm going to admit this only for purposes of argument, not for evidentiary purposes. Okay, now attached to the cover email were almost 300 pages of documents, tax return excerpts, FTB determination letter, an NPA for 2004, an APES for 2004. 2004 is not in dispute, but an audit schedules for 2003 and 4. And then there's other scenarios that were provided that were computed by the taxpayer. Mr. Kaplan, I assume you have no objection to any of these documents being admitted?
Correct, no objection.
Ms. Iskander, was about you.
So with respect to 15, 16, and 17, that is the source of our witnesses' testimony and the source of Exhibit I, and we will offer testimony suggesting that a couple of the amounts on those schedules are not correct, and we've provided correct numbers, but otherwise we're not objecting to admitting these documents, but not conceding that they properly reflect the law on how the amount should be allocated. Okay,
so we will admit, you're talking about exhibits 15 through 18 then, correct?
15 through 17.
Okay, and why is that different than 18?
18 is 197 pages, I didn't look at all.
Yeah,
Oh,
that's what
I'm
we
sorry,
said
you're right,
earlier.
you're right, okay, that's,
Yeah.
correct. Let's go, so let's talk the tax returns excerpts, there's no objection to them, is that correct?
Correct.
Okay, they will be admitted. The NPAs, the APES, and the audit schedules for 2003 and 4, will they, or do you object to those? No objection, okay. And then 15, 16, and 17 will be admitted but not agreed to as to the accuracy.
Correct.
And then Exhibit 18, there's several pages of deficiency scenarios. I think they're at the very end of that exhibit. And the rest of it is basically just K1 information.
Yeah.
So you have no objection to no qualification of any of that exhibit except for maybe the scenarios again?
Yes.
At the end? Okay, and so the scenarios at the end of that document, they will be, again, admitted, but not, you don't agree as to the accuracy necessarily.
Correct.
Okay, great. Thanks for working that out. Now let's go to respondents' exhibits. Mr. Kaplan, maybe you can go quicker. The exhibits that were circulated before the hearing, do you have any exhibits? Do you have any objections to any of those, A through H?
No, Your Honor.
Okay, no objection. And then the new exhibit I. Go.
I would reserve the same objection that appellant just did.
Okay.
For the other ones, we received this late in the day yesterday, and we believe that there is a number or two that have been changed, and I'm sure we'll get into the discussion on what that is and why. So with the same caveat of we will not stipulate that the numbers are correct, we have no objection to that.
Okay, great. Thank you very much.
I can make it a little easier if you'd like me to.
Go ahead, Mrs.
I think that once this panel decides the legal side of the issues, the parties can get together and get to the numbers based on determination this panel will arrive at. So even if we stipulate that we don't agree with necessarily the numbers or how we calculate it, if there's a way that that these numbers can be substantiated, then it shouldn't be a problem given the returns and other documents. I think parties won't have a problem coming up with the right text amount. Given the panel makes a decision as to procedural and substantive issues.
Okay, Mr.
I would agree with that. I would hope that we'd be able to agree on the numbers once we have
Okay.
a determination.
Let's ask you that at the end of the hearing too. We'll ask that question again. Does either party have any questions before we go on the record? No? Okay, great. Then let's go on the record, Mr. Pettit, right? Okay, we are on the record in the appeal of BDCAF OTA case number 1801-11333. The date is May 29th, 2019, and the time is 10:28. This hearing is being held in Sacramento, California, before Judges Jeffrey Margolis, Kenny Gast, and Tommy Young. Will the parties and their representatives identify themselves for the record, starting with the taxpayer?
Edward Kaplan, counsel for the taxpayer.
Leland Hollowell, representing the taxpayer.
For the FTB?
Irina Sikander, tax counsel for the franchise tax board. To my left, we have Greg Suiso, assistant chief counsel for the multi-state tax division, and Michael Cornaz, who is the tax counsel 5.
Okay, thank you.
We should probably also say that we have two more representatives, an auditor, and also another attorney to discuss procedural issues if necessary. It's Brent working.
Okay, that's fine. I would hope, I'm not sure if I said this in advance, but I hope when it comes to the examination of witnesses, you can limit yourself to having one attorney questioning the witness, rather than doing any sort of tag teaming on the witness.
That is our plan.
Okay, thank you. Okay, so let me go over the issues in dispute. The parties have agreed that the issues they've asked us to decide are whether the FTB's interest expense adjustments constitute a new matter such that OTA should prohibit the FTB from raising that issue, or alternatively that FTB should bear the burden of proof on its determination. The second issue is whether the interest expenses deducted by the appellant must be allocated between its in-state and out-of-state non-unitary investments, and whether the expenses allocated to the out-of-state investment should be disallowed. If an allocation is required, how should that allocation be performed? The final issue is whether interest on any deficiencies that might be determined in this matter should be abated or suspended for any period of time. Does that accurately state the issues to be decided? Mr. Kaplan?
It does, Your Honor.
Mrs. Skinder?
Yes, yes.
This is Catherine. There is one additional issue that was raised as an offset issue during this process, which is whether the application of the interest offset under 344B should apply.
Oh, thank you, you're right, that's correct. Is whether interest offset should apply, that's correct. That's an additional issue that was kind of raised.
And it is raised as an offset. We realize it was raised later in the process and it can't result in a refund.
Right. Okay, and I believe there are no stipulations, is that correct? No further stipulations? Let's see. Oh, there's one stipulation that if it is determined that an apportionment of the interest expenses should be based on the original cost of the properties that, of the in-state property versus total property, that the in-state cost represents 27.6% of the total cost of the properties.
Well, again, that percentage was calculated without knowing that California property was purchased prior to the loan. So I'm not sure how we would address this.
Okay.
Because this was not our position, and this is not something that we argued was our position.
Okay. I
So
understand.
if there's you know, whether or not 27.6% is accurate representation of cost basis, it is an accurate representation of cost basis. Whether or not it actually goes to the allocation and should be used under the law, this is the question. Because the allocation is required to be based on two factors, which I will discuss during the argument.
Okay, well, will you also address in your argument whether this new fact that was raised in Mr. Kaplan's brief about the loans being made after the acquisition
Of one of the properties.
of one of those properties, how does that affect your position in chief on the allocation of the
Should I address it now?
No, but will you be addressing that when you get to your argument?
If I have to.
Okay. Okay, then let's go over the exhibits. Parties have agreed that what was marked in the pre-hearing binder that was sent to both parties prior to the hearing, that exhibits numbers 1 and 2 will be admitted, that exhibit 3 will be admitted for discussion purposes only, exhibit 4 will be admitted for discussion purposes only, the exhibit 5, the cover email, will be admitted as argument only. Is that correct so far before we continue?
Yes.
Yes.
Okay, exhibits 6 through 14, they will be admitted without objection. And exhibits 15 through 17 will be admitted, but the FTB does not concede the accuracy of the figures, is that correct?
Correct.
Okay, and exhibit 18, the K-1s and tax documents themselves will be admitted without objection, but the tax computation scenarios will be admitted, but the FTB does not concede their accuracy. Is that correct with respect to exhibit 18?
Correct.
Okay, now moving on to respondents' exhibits. There's no objection to exhibits A through H. They will be admitted, correct? Okay. And then for exhibit I, That will be admitted, but the taxpayer does not necessarily agree to the accuracy of the numbers in that exhibit. Is that correct?
Also correct, yes.
Okay. These exhibits will all be admitted subject to the qualifications that we've discussed in the record. And each side has one witness, is my understanding correct?
Correct. Danny Caldwell is here. We don't intend to call her as a witness, but we have her here. She has great familiarity with the computations and the issues. In the event a question comes up that either I cannot respond to or Captain Freeman, our designated witness, can respond to, we would like the opportunity to allow Danny to jump in.
That's fine. That's fine. And Ms. Iska, do you have one?
We have one.
Witness? Okay. Thank you. Now we're ready for opening statements. Each side will have 30 minutes. I know that the panel's got lots of questions. We will try to hold our, we may ask questions during the opening, but for the most part, we'll try to wait until both sides are done with the opening. Mr. Kaplan, we may begin whenever you're ready.
Before I begin the substance of my opening statement, I would like, since this is on the record and will be in print and in posterity forever, I would like it reflected that today is Kathy Freeman's birthday. I'd like the state of California to acknowledge that.
Well, I will not take that off your time. Happy birthday, Ms. Freeman.
Okay. This matter involves 5 tax years, 2005 through 2009. The notice of proposed assessment with respect to the 2005 and 2006 years was issued on February 17, 2011. A little more than a year later, on May 9, 2012, another notice of proposed assessment was issued for the 2007, 2008, and 2009 tax years. Each of those notices was protested, and after the parties were unable to resolve the issues during the protest stage, notices of action were issued for all 5 years on September 28, 2015. Appellant filed a timely appeal on October 28, 2015, after the statute of limitations for assessment had expired for all tax years involved. The notices of action for each of the 5 years involved 2 separate issues, both of which were appealed to the Board of Equalization and transformed into the current action before the Office of Tax Appeals. The first issue was whether the taxpayer's separate investments in real estate ventures are independent activities or a single trade or business requiring it to be taxed on a unitary basis. The second issue was whether cash advances made to the taxpayer by his sole shareholder were bona fide loans, as the taxpayer claimed and reported, or capital contributions. A third issue was initially present in the notice of proposed assessment with respect to 2006, whether the taxpayer was entitled to tax-deferred exchange treatment under Section 1031, or whether the disposition of its interest in certain relinquished property is properly subject to immediate tax. This issue was conceded by the protest hearing officer prior to the issuance of the notice of action for 2006 and is not before this panel. Again, this appeal was filed on October 28, 2015. In the hopes of being able to resolve both the unitary and debt equity issues without the need for a formal hearing, the taxpayer did not object to extensions for the Franchise Tax Board's filing of its opening brief while discussions took place. In that opening brief, filed on December 20, 2016, the Franchise Tax Board conceded both of the remaining appealed issues in full, in effect resolving all of the audit adjustments in favor of the taxpayer. It agreed that the taxpayer was not unitary and did not have to file returns on that basis, and it agreed that the cash advances made to it were bona fide debts, not equity investments, and therefore agreed that the taxpayer was entitled to treat repayments back to its sole shareholder as deductible interest and not as non-deductible dividends. Although dismissal of this action should have resulted from the concessions of the only 2 issues appealed, Instead, the Franchise Tax Board raised a new issue for the first time in its opening brief. Specifically, the Franchise Tax Board asserted that although it now finally agreed that the taxpayer was entitled to claim interest expense deductions, such deductions should be limited to the taxpayer's indebtedness used to invest in California properties. In other words, the Franchise Tax Board now argued for the first time an entirely new and distinct issue from those previously raised at audit, that the taxpayer's interest expense deductions should be allocated between the states in which property was owned and not allowed to be fully deducted from its California income. Taxpayer asserts that this constitutes an entirely new issue raised after the statute of limitations expired, and the Franchise Tax Board should be precluded from raising it at this time. This issue was not raised in the Notice of Proposed Assessment on February 17, 2011, after years under audit, nor was it raised in the subsequent Notice of Proposed Assessment issued May 9, 2012. Franchise Tax Board does not argue here that it was in any way precluded from raising this issue during the lengthy examination process. Further, this issue was not raised or discussed in any fashion during the following 4 years that the matter was before the protest unit. Again, there is no assertion here that the Franchise Tax Board was somehow precluded from raising this issue at the protest level. What the Franchise Tax Board does argue is that in raising this issue more than a year after the taxpayer's appeal had been filed for all 5 years, that this is not a new issue, and that all of the information necessary for its delayed determination was in hand, that the facts necessary to an analysis and determination of this issue did not require presentation of additional or different evidence. Such an argument, however, only emphasizes the injustice that would result from allowing this issue to be raised now. There is no dispute that the Franchise Tax Board had every opportunity, with all of the taxpayers' information in hand, to raise this issue as an alternative to the question of debt versus equity, but it did not do so, not at the examination level, not at protest. It is not uncommon for a taxing agency to assert alternative theories with respect to the proper treatment of a particular item, but that is not what occurred here. By statute, a Notice of Proposed Assessment is required to inform the taxpayer of the basis for the Franchise Tax Board's assertion that additional tax is owed. Once issued, the Franchise Tax Board's published policy provides that new issues should rarely be pursued after audit, and in no circumstance will they be allowed to increase the amount of tax originally stated as due. It is akin to a statute of limitations. If a party has something to say, there are timelines within which it must be said. The question of whether advance funds are properly characterized as debt or equity is entirely different than the question of the appropriateness of an allocation of interest expense deductions. Debt versus equity looks to the character of the transactions to determine which set of rules to apply. Allocation of an expense, however, is not character-based. It is much more of an accounting issue and involves a completely different analysis of a completely different set of facts. Further, there is a question as to whether all the necessary information was truly at hand. The Franchise Tax Board's opening brief references the additional information provided by the taxpayer subsequent to the filing of this appeal. While this additional information led to respondents' concession on the unity and debt versus equity issues, it is now being relied upon in part to support its new issue. The legal division should not be allowed to engage in a new examination of the taxpayer's return after the statute of limitations expires. This is not an instance where fraud or misconduct was discovered unknown at earlier stages of the procedural process. The Franchise Tax Board also argues that the question of interest expense allocation is not a new issue, and that under its position, if correct, it does not result in an increase in tax that would be owing beyond what is asserted in the notices of action. But this is also not quite true. As can be seen in what has been marked as Exhibit 3, as well as the new Exhibit I believe it is. Under the Franchise Tax Board's methodology for allocating interest expense deductions, in at least 2 of the 5 years, the resulting tax would be significantly greater than that shown on the notices of action. Granted, the Franchise Tax Board agrees that it is not entitled to that increase, but that is for policy reasons and not prohibited by statute. In other words, to borrow from the terminology used in criminal matters, the allocation of the interest expense deduction is not a lesser included offense of the determination of whether the character of a cash advance is debt or equity. This allocation issue should not be allowed to be raised at this stage under the circumstances of this case. In the event that the Franchise Tax Board is allowed to raise this allocation issue, 2 new corollary issues arise. The first is which party has the burden of proof. As this panel is aware, the issue in dispute is whether an allocation is required. If so, the question then turns to the methodology to be used in making such an allocation. Obviously, it is the taxpayer's position that the burden lies with the Franchise Tax Board on both of these questions. A second corollary issue is potentially lurking, applicable only if this panel ultimately determines that additional tax is owed in any particular year. Interest would accrue on any such deficiency, normally from the date the tax return was due until the date of payment of that tax. Here, in light of the fact that the taxpayer was never made aware of the issue that would result in additional tax owing until the Franchise Tax Board filed its opening brief on December 22, 2016, never had an opportunity to discuss this issue with either the examination agent or the protest hearing officer, the taxpayer should not suffer the effect of interest accrual during the entire time this matter has been at issue. Under Revenue and Taxation Code Section 19116B1, as in effect for all years at issue here, interest on tax deficiencies is to be suspended starting 18 months after the filing of the return, starting up again only when the taxpayer is notified that the Franchise Tax Board believes additional tax is owed and why. In this case, the earliest interest would properly start to accrue again would be the December 22, 2016 date that the Franchise Tax Board notified the taxpayer of this new issue.
That date again, September or December?
December
December 22nd,
2016. Because she is able to explain the interest deduction and allocation rules far more intelligently than I can, I've asked Kathy Freeman, formerly from PwC, as well as from the Franchise Tax Board, to be here to discuss the details of this aspect of the case. Kathy was intimately involved in our discussions with the board on this issue and oversaw the tax computations for the taxpayer under the various methodologies being discussed. Without trying to step on her toes, I will let Kathy explain more about why the statute of limitations has expired, prohibiting the raising of this new issue, as well as why no allocation at all is warranted in this action. If it is, Kathy will explain why the allocation is to be done after determining the taxpayer's net income. That is, after offsetting its income by its interest expense to determine its net income and then allocating only any excess. Finally, Kathy will explain why the authorities cited by the Franchise Tax Board to support its position are simply inapplicable to the facts of this case. Each of the authorities relied upon deal with the proper treatment of expenses attributable to generating tax-exempt income. Franchise Tax Board has tried to shift the focus to Revenue Procedure 72-18, but that is the wrong place to look. The IRS has explained the purpose of this revenue procedure in its Revenue Ruling 2004-47. I'm going to read now just the first few lines of the Law and Analysis section of Revenue Ruling 2004-47. This is the IRS's own explanation of this revenue procedure. In general, a deduction is allowed under section 163 of the code for all interest paid or accrued on indebtedness. Under section 265A2, however, no deduction is allowed for interest on indebtedness incurred or continued to purchase or carry obligations, the interest on which is wholly exempt from federal income taxes. Revenue Procedure 72-18 sets forth guidelines on the application of section 265A2. Again, we do not have tax-exempt income in this matter. We have no quarrel with the authorities cited by the Franchise Tax Board, only with their relevance to this case. They simply have none. And again, if this issue is allowed to go forward, the Franchise Tax Board has the burden of proof every step of the way. The Franchise Tax Board has relied on Revenue and Taxation Code Section 24425 as the basis of allocated interest expense in this case, and has not relied on CCR Section 25120 D in parens. While the Revenue and Taxation Code cited 24425 may have relevance with respect to income excluded from the measure of tax, no such income exists in this case. There is no tax-exempt income. The Franchise Tax Board, after being silenced on the two issues appealed to the Board of Equalization, continues to bark, but it's barking up the wrong tree. Accordingly, absent relevance to the expense allocation at hand, the Franchise Tax Board position should not be rejected if it is even allowed to be considered by this panel. Thank you.
This is Kathy Freeman, and I'm going to elaborate on his argument more on a technical basis. So basically, in this case, the tax year was audited for 2 cycles, and 3 adjustments were made. The first issue was.
1 second, Ms. Freeman. Do you have any problem with that? Okay, continue.
So there were 3 issues. The first issue was based on whether a unitary business existed under 2501 Revenue Taxation Code. The second issue was whether money contributed to the taxpayer was debt or equity, and that was an adjustment based on Revenue Taxation Code Section 24344A, and which is California's conformity to IRC Section 163, which relates to interest expense deductions. And the third issue was the validity of a like-kind exchange adjustment for 2006. Procedurally, at protest, the like-kind exchange adjustment was withdrawn, leaving just the first and second issues at hand. During their discussions after the appeal was filed, the FTB has conceded both issues that were appealed. The issue of whether there was a unitary business between the partnerships holding the properties and the deductibility of the interest under IRC Section 163. So all of the issues were conceded. The reliance of the primary issue, which is in dispute here, was a 24344B issue, or A issue, whether it's deductible interest. What was raised in the FTB's brief filed in December of 2016, which was, by the way, filed after the statute of limitations expired, was a new issue based on 24425, using an expense allocation under Revenue Procedure 72-18 to allocate interest between the various partnership investments in the real property. So our position, first and foremost, is that it is a new issue, similar to what happened in ComCom, when they raised a sales factor issue, and the court denied it, even though it was related to the issues at hand. This was a new issue based on a new statute, and it was barred by the statute of limitations. We believe in this case that raising a 24425 issue is not permitted. We believe that you could perhaps raise a new theory under 24344A on how to disallow the interest, but 24425 is a different issue, allocating interest expense to exempt income. We believe further, and we're not arguing the entity's case, that if an expense allocation is warranted, it should have been done under California Code of Regulations Section 25120E, which provides.
D as in dog.
D as in dog, which provides for, and I can read it to you, I have actually written it down.
We're familiar with it.
Okay. It does provide for the allocation of expenses to, between business income and non-business income, or between different trades or businesses, or between various non-business investments. And what it says in there is you use a reasonable method. There's no set way to do it. And actually, if you read the FTB's audit manual, they provide various means to allocate the interest based on a reasonable method. In this case, the FTB is insisting on either based on the original investment or changing investment over time for these partnership interests. We proposed, if one was warranted under 25-120D, we don't believe any adjustments warranted under 24-425 because we don't have exempt income, that we believe that based on cash flow, ability to repay the debt, which was the basis for the loan itself and all the documents we discussed, that they lent us the money based on our ability to repay, which is based on cash flow. We have provided that analysis on the ability to pay in the documents that we provided. And that would be a reasonable method based on the FTB's own NAPM, not an NATM manual. And it's in section 4060. So even if an allocation was warranted, the FTB is citing the wrong code section and has not raised 25-120D in any of its briefs as a means to allocate the interest. So if 24-425, which is allocating interest expense among its investments, is not the proper authority, the FTB has not raised the proper grounds to allocate the interest, and their argument should fail based on the lack of arguments within the statute of limitations. I would go further to say that Revenue and Taxation Code section 24-425, California, for franchise tax purposes, doesn't have exempt income. And the only time you actually see this issue raised is for dividend deductions under RMTC section 24-410 related to insurance dividend deduction. You don't see it for 24-411, which is a 75% guarantee because it is a separate interest allocation for that purpose under 24-344C. And you don't see it for the dividend elimination because there isn't a provision to allocate interest when there's limitations. So we don't think the FTB has raised the right arguments to achieve an offset in this case or an allocation. And I think our final argument here is that even if they were to be sustained, the interest offset under 24-344B should be applied in this case as an offset issue. The FTB has raised the fact that they believe that an offset is required. It should be done after you allocate the interest expense between California and non-California investments. However, if you look at 24-344C, that allocation itself is done before you consider business and non-business income. Further, if you read into 25-106.5, the FTB has reserved and provided no guidance on this. So we believe that the 24-344B allocation for the interest offset should be done consistent with the allocation under 24-344C, which also does the allocation before consideration of non-business income.
Is that it?
Yeah.
Thank you very much. Mrs. Skinner?
Good morning again. To see this case for what it is, and it is really not a complicated case, it is important to keep in mind the original issues of this appeal and how the resolution of those issues still resulted in this hearing. This appeal was first filed during audits. Was first filed because during audits and protests, undocumented protests, respondent disagreed with the appellant's filing position and determined that first, appellant and its pass-through entities constituted a single unitary business subject to did proportions and allocation rules, and second, that the $156 million funds that appellant received from its UK parent, pension trust owned by British Broadcasting Corporation, also known as BBC, were contributions and not loans to appellant. As a consequence of treating funds as contributions, respondent denied interest expense deduction associated with the funds in full during audit and during undocumented protests. Appellant disagreed with respondent's positions and appealed. In its opening brief, appellant stipulated that it was organized by BBC Pension Trust as a Nevada corporation, that it was an entity with no employees, and it had no business office in the United States, that it was formed to facilitate BBC Pension Trust investments in U.S. real estate, and not to engage in an active trade or business here. Rather, appellant's business consisted of passive ownership of investments. In fact, appellant stipulated that it functions essentially as a holding company that oversees its investments, and it is nothing more than an investor with oversight rights related to its investments, as opposed to an active participant in operational management of any of those investments. Essentially, appellant held interest in limited partnerships, LLCs, and tenancies in common as a limited partner or non-managing member or tenant. Each pass-through entity owns a separate commercial real estate. Each real estate is located within a single state. All aspects of each pass-through entities are managed by a Grosvenor, an unrelated entity and the other partner in these investments. Appellant relied entirely on Grosvenor for operation and management of its properties. For an administrative fee, Grosvenor also provided accounting, auditing, and tax functions for the investments. As to earning income, in its opening brief, appellant stipulated that appellant's income is solely attributable to the distributive share generated from rental activities of partnerships. That there is nothing from the operation of one of the taxpayer's property interests that affects, positively or negatively, its other property interests conducted inside or outside of the state. As far as its interest in real properties located in and outside of California, appellant also stipulated that the pass-through interests are distinct from each other, as they do not cross-pollinate in one manner or another. There is no part of any pass-through interest contributes or depends on any part of the other pass-through interests. Based on these appellant stipulations and corroborating evidence that appellant provided during this appeal process, and this is the additional evidence that allowed respondents to agree with appellant that appellant was not engaged in unitary business with its pass-through entities, and that each of its pass-through interests constituted a separate trade or business, generating income source to a single state. This respondent's concession is particularly important because it puts the question of the UDITPA provisions application in this case to rest, as appellant is not engaged in unitary business that generate income with or without California. Appellant is not subject to UDITPA apportionment or allocation provisions, which are covered in Revenue and Taxation Code 25140 through 25140. The second issue, originally on appeal, involved classification of $156 million funds appellant received from its parent, BBC Pension Trust, as either debt or equity. Once funds are classified in one way or another, certain tax consequences follow naturally based on governing law. If funds are deemed capital contribution, the tax consequence is there can be no interest deduction that is associated with the funds. If funds are loans, the recipient is entitled to the interest expense deduction, but only to the extent that interest deduction is attributable to taxable in California income. In an attempt to resolve this appeal, respondents agreed to treat $156 million in funds from BBC Pension Trust to appellant as loans. Again, because the loans were reclassified, because the funds were reclassified as loans, California law mandates that certain tax consequences follow. Tax consequences here are part and parcel of reclassification, and respondent is not free to ignore the law that reclassification triggers automatically. But, as it stands today, while appellant agrees with reclassification, it argues that respondent should be precluded from enforcing the tax consequences that tax law mandates. As such, despite FTB's concession on both issues, the actual issues before this appeal is a procedural issue of whether, by merely respecting the consequences associated with treatment of funds as loans during the appeal, FTB is raising a new issue and must carry the burden of proving the tax consequences. And the second substantive issue is whether and to what extent should a balanced interest expense deduction be allowed against its California income. There's also an interest expense issue, the interest on assessment issue that we will address as well. As to procedural issue on whether the issue is new or not, the application of tax consequences following a change in treatment of funds from contributions to loans cannot be a new issue. In appeal of Mendelssohn, Board of Equalization ruled that an issue is not new if it does not increase tax and it does not require introduction of the new evidence or facts. A tax consequence of allowing a previously disallowed expense mathematically cannot result in more tax because allowance of a deduction previously disallowed reduces taxable income. And application of tax consequences does not require an introduction of new facts. The same facts that allowed respondent to treat funds either as loans or contributions determine the consequence of the classification. As those facts did not change from added, respondent's assessment of the same facts changed, not the facts. Therefore, by enforcing California law and the correct tax consequence, respondent is not raising a new issue. However, for the sake of the argument, FTB will proceed as if the issue was new. Under Mendelssohn, this merely means that the burden of proving the extent of the allowed deduction would have shifted to the FTB. Having evidence on file provides FTB in this panel with sufficient reasons of establishing the need for limiting the extent of a balanced interest expense deduction. We'll first start with the law. California Revenue Taxation Code 24425 specifically imposes a matching principle between income and deduction. In essence, that section directs that expenses incurred in generation of income excluded from California tax base should also be excluded from California. Notably, allowing expenses unrelated to generation of California income would effectively result in a double deduction. First, in the form of the included income, and second, in the form of reducing included income by unrelated to that income expenses. Now, looking at the structure of California Revenue Taxation Code, Articles 1 through 3 of Chapter 7, Part 11 is instructive in calculation of net income for California purposes. Revenue Taxation Code 24341 defines net income as gross income computed under Chapter 6, less the deductions allowed under this article and Article 2, commencing with 24441. Article 1 and 2 cover various allowable deductions. Article 3 of the same part specifies items not deductible. Article 3 begins with Revenue Taxation Code 24421, which states that in computing net income of taxpayer under this part, which includes Article 1 and Article 2, no deduction shall be allowed for the items specified in this article, Article 3. Specifically, therefore, Article 3 directs for exclusion of certain deductions, notwithstanding Article 1 and 2. Furthermore, subsection A of Revenue Taxation Code 24425 specifically states that no deduction shall be allowed for any amount otherwise allowable as deduction which is applicable to one or more classes of income not included in the measure of tax imposed by this part, regardless of whether income was received or accrued during the taxable year. In appeal of Signal International, the Board of Equalization held that RTC Section 24425 controls over Revenue Taxation Code 24344, which addresses the allowable deduction for interest expense. The Board of Equalization stated, the overriding language of Revenue Taxation Code 24425 compels us to conclude that the section is controlling over Section 24344. We have previously reached that same conclusion with respect to predecessor of these two sections. Furthermore, a few years later, California Supreme Court also took a closer look at Revenue Taxation 24425 in Greater Western Financial Corporation. In Great Western, a taxpayer, after deducting certain dividends from his gross income pursuant to 24402, excluding the deduction portion from California measure of tax, so to also deduct the interest expense attributable to the excluded income dividend, from the income dividend. While respondent allowed for the dividend received deduction, it applied section 24425 to deny the deduction for the expenses attributable to the excluded income. California Supreme Court, the trial court ruled for the taxpayer, and the California Supreme Court reversed and remanded, emphasizing the broad nature of revenue taxation 24425. It says, section 24425 is operated whenever income is eliminated from the measure of tax under any authority for any purpose. It states with incontestable clarity that items not deductible when allocable to income not included in the measure of tax. The purpose of this section is to prevent a double exemption. So evidence, this is the law, and the law mandates that 24425 trumps 24334. Now, whether do we have an evidence to support the fact that some of the interest deduction is not related to production of interest, production of income from investments? Evidence in file supports the finding that appellant borrowed $156 million from its parents and invested a big chunk of the funds in assets that do not generate California income. First, appellant stipulated that it is a passive holding company with the sole purpose of facilitating BBC Pension Trust investments in U.S. real estate. It has no other function. Appellant borrowed from his parent $156 million, all of which is accounted for in Respondent's Exhibit A. The promissory notes were submitted as part of the audit in 2009. It is not the new evidence. In Respondent's Exhibit B, appellant stipulated the loans were provided so that BBCAP has sufficient funds to make capital contributions to existing or new joint ventures, which were acquiring real estate investments in the U.S. This evidence submitted in response to an audit ITR. It is also not a new evidence. Income from each investment is sourced to a single state based on the real estate location here. Hence, only income from California real estate is included in California tax base. This is also not a new evidence. In fact, this is how appellant filed its tax returns. Since all of the loans were used to invest in existing and new real estate investments, it follows that interest expense on those loans is attributable to investments that generated income that was both included and excluded from California tax base. It follows, therefore, that appellant should be able to deduct from his California income only that portion of the expense that is attributable to assets generating income from California, is attributable to California real estate that generated California income. So the deduction unquestionably must be limited. The only question here really is how and in accordance to which formula. While appellant appears to be bringing up various UTIPA provisions to divert this panel's attention from general law that applies to allowable deductions, respondent would like to remind this panel that appellant does not generate any apportionable business income or allocable non-business income. The Uniform Division of Income for Tax Purposes Act provisions covered by Revenue Taxation 25, Sections 25.120 to 25.140 was enacted to address businesses that operate a unitary business within and out of California. Appellant here does not operate a unitary business, and none of his investments generate income subject to taxation in more than one state. UTIPA provisions, therefore, are not applicable in this case, including Revenue Taxation Code Section 25.120. Again, this case before this panel is much simpler once you consider that UTIPA provisions do not apply, and 24.425 provides guidance. Now, we come to allocation methodology. Respondent draws attention to the appeal of Zenith, a 1998 published Board of Equalization decision, which a California Court of Appeals found persuasive in Apple v. TV in 2011. Zenith and Apple are precedential on the issue, and must be considered by this panel in deciding this case. In Apple, the Court of Appeals summarized appeal of Zenith to stand for the rule that the proper allocation of interest expense involves two considerations. One is the purpose of the borrowing, and two, an accounting as to how the funds were actually used. Unless the taxpayer can establish a direct allocation between the borrowing expense and the investment purpose, the FTB's allocation would otherwise apply. And this is a quote from both Zenith and Apple. In Apple, the court, at page 25, states, we again find the State Board of Equalization analysis on this issue persuasive. This issue is not whether FTB may seek and allocate otherwise deductible expense between taxable and non-taxable income. Unquestionably, it can. The question is simply whether Apple then met its burden on the totality of facts and circumstances to establish that its dominant purpose in the borrowing and the actual use of the funds was to support and was allocable to its domestic income-producing activities. What was involved in Apple with respect to the interest deduction issue is Apple included domestic income-producing activities which were taxable and excluded foreign activities. So the Apple's burden was to show that the interest expense deduction was incurred in order to sustain its domestic operation and not its foreign. And because Apple provided sufficient evidence of direct tracing, the court honored it by allocating interest expense among the income-producing assets that Apple conclusively established were funded by the debt, which produced California taxable income. In this case, appellant in its reply brief stipulates that it is unable to directly link debt to specific real estate investments. Because the appellant is unable to directly link funds to specific assets, both Zenith and Apple decisions direct that FTB's formula should then apply. Specifically, both FBE, or State Board of Equalization, in Zenith, and Court of Appeals in Apple stated, unless the taxpayer can establish its dominant purpose and a sufficiently direct relationship between the expense and the income, respondent's allocation formula will provide the best means to allocate interest expense between taxable and non-taxable activities. In Zenith, taxpayer was not able to directly link borrowings to specific assets during one of the years at issue. For that year, State Board of Equalization endorsed IRS Revenue Procedure 7218 by stating that Revenue Procedure 7218 provides the most workable solution over the long term and should be used in order to calculate the non-allowable portion of the deduction. That is exactly what respondent did in this case. Based on evidence collected during audit that conclusively established that appellant borrowed $156 million to invest in its real estate, and I use word borrowed broadly, throughout the United States and on behalf of its parent entity, respondent seeks to allocate the interest expense on those loans among appellant's California and non-California real estate investments based on the asset's average adjusted basis. The IRS Revenue Procedure formula specifically provides that disallowed expense should factor in average adjusted basis of the excluded assets, here non-California real estate investments, over appellant's total assets, which may or may not include additional to real estate investments assets. Respondent's Exhibit F provides such calculations. There is absolutely no basis to treat Revenue Procedure 7218 formula that respondent seeks to apply as unreasonable. Nothing in the evidence supports a proposition that respondent's formula is unreasonable, or even that an allocation based on income is more reflective of appellant's purpose and use of the funds. Respondent's Exhibit F and I are to the point, and respondent is open to any questions this panel may have on the issue. As such, this panel must sustain respondent's position in this case.
Okay,
Thank you.
Thank you. Panel members, have any questions at this time?
I want to know whether, I guess I'm the witness statement is in or
There will be witnesses for each side.
not can I be the witnesses and speak to this?
Chuck, you ask some questions out there.
Yeah, I have some clarifying questions. Maybe we'll start with FTB. Actually, we'll start with the taxpayer. How the returns were filed. If we start with 2005, it seems like both parties agreed that the non-California, non-unitary partnership distributorship income was not included in the returns. Is that how?
It was removed from the return, it was in the base
Okay.
and taken out as non-business, it's not treated as exempt income in the return.
Okay,
So there's no Schedule R to take it out as non-business on those returns, as I recall.
We made an adjustment on the face of the return because the rest of their business activities were wholly within California, there wasn't a need for a Schedule R.
So there's a subtraction or something.
There's a subtraction, yes. And it was treated as business income removed on the face of the return through an adjustment. Subsequently, we've made more refinements in the schedules we've provided to more, to go back and forth between what the auditor did and the corrections to the base to reflect what should be treated as California's business income. It is subject to UNIDA because it is a single taxpayer with partnership income within and without the state. And 25-105 does say it applies to a taxpayer that has activities within and without the state. And it is a single legal.
25-101.
25-101, yeah. Does apply. It does apply because the activities of a single legal entity are done within and without the state. So, while it may not be a standard methodology to treat non-business income to remove from the base of return, that's not the first time I've seen it done that way.
you say non-business, how come, and you think you did apply, but what about 25-137-1?
Partnership returns?
We have a separate trader business.
So basically under 25-137-1, each of the partnerships, if they're not unitary, they're treated as separately allocable and allocated, or apportioned at the partnership level and then treated as added together the pieces that are California sourced and on a post-apportioned basis taxed for each of the partnerships added together. Because you wouldn't add them together and apportion the whole piece, you apportion each taxpayer in California, or each investment in California to get to the
Okay, and because the non-California, non-unitary partnerships essentially are separate trades or businesses and don't have any California apportionment, that was, yeah, so it was essentially deducted from the California return as a subtraction adjustment?
Yeah, you get to the same answer whether you do it using Schedule R or the methodology where a taxpayer employee. Essentially, everything that's being pulled out on the face of the return on side 1 is not going to be added back as post-apportioned partnership income. Taking it out has the same effect as doing it after, on Schedule R after you apportion income, and not adding it back. You get to the same answer.
Okay.
Mechanically.
Okay. For FTB, if you're arguing this is, the taxpayer is not subject to UDIPTA, then isn't all of its income and losses taxable? Aren't they 100% California?
No, it's not. Okay, so there's an appeal of Holloway Investment Company in which a similar situation was involved. The taxpayer owned several pastoral interests in different states. And that Board of Equalization decision specifically states, for our purposes, unless a unitary business exists, there can be no business income. The income in question would merely be specifically allocated by CITES. Because here, we don't have business or non-business income. They have income from their pastoral entities. But because it's not unitary, the income by each pastoral entity only is sourced to a single state based on the location of the real estate investment that's part and parcel of that pastoral entity.
So is that separate accounting?
It is in a way separate accounting, basically, they source all of their income, they have to source all of their income from pass-through entities that own commercial real estate in a different state to that specific state. And they only can source to California under that theory, under the theory that they have separate trades or businesses. Only that income that is attributable to California real estate. So even California real estate, let's say that they have like 4 or 5 properties in California, even each of that real estate and pass-through interest is separate from other California real estate or interest. So if they apportion, they're not apportioned, I'm sorry, they taxed by situs and not by allocation and apportionment. And if we go back to the DIPA provisions, for one, revenue taxation 121 specifically provides any taxpayer having income from business activity which is taxable both within and without California is subject to allocated and apportioned net income as provided in this UDIPA Act. What that means is, had they had a pass-through interest that generated income within and without California, that would be subject to apportionment. Then one state would take a chunk of it and the other state would take another chunk. But here they don't have it. Each pass-through entity's income is limited to a single state. There is no issue of apportionment and allocation.
But under your theory, even if one of the pass-through entities was an apportionable entity, you're taking the position that UDIPA wouldn't apply because the parent taxpayer
Is not unitary.
is not unitary, so.
But we are not there. So, you know, based on what we have here is we have this situation. The taxpayer owns various pass-through entities, and each pass-through entity's income is limited to a single state. So under the current facts that we have right now before us, UDIPA provisions simply are not triggered.
Well, I'm just kind of wondering what would happen if you have, I mean, what if you had one of the partnership entities was an apportioning taxpayer, and it's not unitary, as here with the parent company? How would we treat the income from that partnership entity? Would it be apportioned to California? And, I mean, does it come in under UDIPA or not?
I'm sorry, I can't answer that question on the fly. I would have to think about it and get back to you if that's important in this decision. But
what would
under
end
the
up
fact,
happening, pardon me, Craig Suiso, is if what you're asking for is, let's say you had a partnership that wasn't unitary with the partner, correct?
Correct.
Okay, and that partnership does business within and without California, correct?
Correct.
Okay, you would use the apportionment factors of that partnership to determine the California source income of that partnership. That would be the distributive share to the partner.
Okay, thank you.
that is a presuming.
Yeah.
So,
Presuming, and they're not unitary with one another, that would be under regulation 2537-1G.
so the -1G, doesn't it have examples in there of partnerships that are wholly outside of California, and there, I think there's a loss, and then that gets either wholly allocated to California or not, depending on if the partnership's within or without California? If so, why does that regulation apply in that situation but not in these facts?
If I understood you correctly, you're saying that there is an example under 25137-G where you have a partnership that has a loss, but the partnership in and of itself has no activity in California?
It's a non-unitary
Yes.
partnership, yes. It has no activity in California, has a loss completely generated in another state.
Correct. And none of that activity would be considered for determining the overall California source income of the partner of that non-unitary partnership, because that activity would be assigned to another state, because obviously then none of that entity, that partnership's factors would be in California since it had no activity in California.
Okay, so why does UDIPTA, that regulation, apply in that situation but not under these facts? What's the
Theoretically, what UDIPA is, the standard for UDIPA is when you're dealing with necessarily a taxpayer. So when you're talking about a pass-through, it comes down to the entity agency theory under a pass-through. So when you would look at the UDIPA for purposes of sourcing the income of a non-unitary taxpayer, because obviously that does business within and without California, correct? You would look at UDIPA. But in this fact pattern, it's agreed that each of these individual pass-through entity interests are localized in California. So you don't necessarily need to rely on UDIPA for determining their California source income, because in effect, all of the activities in California, in other words, is saying all of their factors would be in California. So you don't really need to look to UDIPA.
Okay, thank you.
I have a question for probably Ms. Freeman. So why do you contend that if UDIPA applies, which you seem to think it does, why does 25120D not apply here?
The FTB, so at audit, the FTB only raised the issue of 24425 at appeal. At audit, the only issue raised was 24344A, the deductibility of the interest expense. 24425 is a new issue. They have not raised the interest allocation under 25120D at all. So that's not technically before the court. It's our position that 25101 does apply, which applies when a taxpayer subject to tax imposed under this part has income attributable to sources within or without the state. We have that situation. My taxpayer has partnership interests that flow through to it as a taxpayer that are within and without the state. And the rules, we believe the rules under 25137-1 would apply, which is why we removed the allocable income on the face of the return and didn't source it on a post-apportioned basis. When you take and silo each partnership and apportion the activities of each partnership, none of it comes to California for the out-of-state partnerships because they're pretty microcosm into whatever particular state they were in. We believe 25137 would apply to determine the amount of income that would be attributable to California, and that's what we've provided in those schedules. And we believe 25120D would apply to allocate the interest amongst the partnerships after the interest offset applies if the FTB had actually raised that issue.
Okay, so your position is that they can't, the FTB can't use 25120D because it's kind of renouncing it in this case.
They have not raised that issue.
Okay. Thank you. Let's take a 10-minute recess before we go to the witnesses. Okay, thank you very much.
I just noticed now, and 4. So we need to get that clarified.
Spelling's great. Was it an ATM manual or? M-A-T. Okay. R. That's fine, just the,
Revenue and taxation.
and D or D's are.
Dividend distribution.
Great, thank you. No problem.
I guess I could.
Yeah.
We have the one out here.
I'll do the number 2, please.
both.
Right.
If it doesn't, then it doesn't.
Then you don't need it.
Right? Exactly.
The comment about
Okay, you ready to get back on the record? Everyone? Ready? Mr. Kaplan, would you like to call your first witness?
This time I'd like to ask Kathy Freeman to as our witness.
Ms. Freeman, would you prefer to testify from there, or would you like to go to the witness box? It's your choice.
I'm here, Your Honor.
Okay, that's fine. Ms. Freeman, please stand and I'd like to swear you right now. Do you solemnly swear or affirm that the testimony you will be giving today is the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Be seated.
And I believe that most of what Ms. Freeman was going to be testifying to, she covered to a great extent in, as part of the opening statement. If possible, I would like that the comments made during the opening statement that came from her to be used as part of her direct testimony.
I can repeat it if you like.
What's that?
I can repeat what I initially said if you like.
Mrs. Skinner, would you like her to repeat it for you?
Not for me, no.
Okay, that'll be admitted as her testimony.
Thank you, Your Honor.
The only other comment I would add is that we have offered a methodology, both 24.425 and 25.120B both offer reasonable methods of allocation. The MATM section 4060 also discusses alternative methodologies to allocate expenses between biz, non-biz, or even between exempt income and non-exempt income. And we believe our method is reasonable, and the FTP has not provided any evidence whatsoever to rebut the fact that our methodology is just as reasonable as their method. And so we do not believe, in the event it comes to that point, that they've met their burden of establishing our method is unreasonable.
Any questions further for Ms. Freeman?
I guess I have one question, and that is, during the FTB's opening statement, I believe what I heard was, with respect to the question of whether this is a new issue, the allocation of interest is a new issue or not, that the interest was recharacterized as such, and that the question of allocation naturally follows from this recharacterization. I would like to ask Ms. Freeman, how was the interest originally reported on the tax returns, and whether such a recharacterization did in fact occur?
So I did spend 23 years at the FTB as a significant chunk of those years as an FTB auditor and also providing legal support work for the FTB legal staff.
Speak more slowly.
So I did spend 23 years at the FTB providing both as a field auditor in the technical resource section, reviewing audits and providing legal support for the entity attorneys. When you look at the return as filed, like I had discussed earlier, there's different ways that returns get presented. There's a general way, and then there's unique ways to present the same information. Sometimes the numbers, they get to the same point, it's just the presentation is a little bit different. Here's a situation where the presentation was different, but you get to the same result of treating the income as non-business. When you examine an expense, in this case, interest expense was reported on the return and deducted, as well as interest income. The taxpayer reported the interest income and interest expense just as that. The FTB had proposed to recharacterize it as not interest and thereby denied the deduction for interest expense. So nothing changed here. The issue of an interest allocation is a separate and unique issue where you would have perhaps an insurance, a receipt of an insurance dividend, and then Zenith would apply, or you would have allocation issues, which you usually see on the supporting schedule, the Schedule R, where you have non-business income, and then you net those adjustments and add them back in on Schedule R on a post-proportion allocated basis. So an interest allocation issue does not logically flow from the audit issues proposed. That's a unique issue that would be raised.
I have a question. Continue.
That was it.
Well, are you saying that if an interest expense allocation issue had been raised, I mean, are you saying there was an interest expense allocation inherent from the beginning in terms of, as originally reported,
Yes.
there perhaps should have been an interest expense adjustment even if there was no change in their unitary status or anything?
I'm not aware whether the taxpayer was aware that an allocation was required, and the return is reported, but if the entity was looking at the fact that you had multiple partnerships that were treated as non-unitary, an interest expense allocation would have been a logical issue for the auditor to pursue. They did not choose to pursue that issue. Instead, they chose to pursue whether it was a contribution to capital or debt. That is a unique issue that exclusively falls under IRC Section 163. California would conform to the same rules as federal in determining whether it's debt versus equity. And that was what it was. That's what the auditor chose to audit. They could have pursued an expense allocation issue. They chose not to. Those are two very unique issues.
Are you done with your direct?
I would like Ms. Freeman to one question. Can you discuss the concept of the measure of tax?
Yeah. So when you look at the return, Schedule F is usually the income computation, whether it's done in conformity with the federal return or a worldwide basis. And that number carries over to line 1. And you can determine how income is computed by comparing what's on line 1 to the federal return. If it doesn't tie, then you have to go back and look to see if they've added in foreign. That's one methodology, but really line 1 is the income base, and side 1 of the return is used to make state adjustments from federal to state numbers. For example, caffeine and wash normally is adjusted on side 1 of the return. California only dividend deductions are made on side 1 of the return. Contribution adjustments, tax measure, that's all differences between the tax base and fed state differences. All of the income, including non-allocable income, is included in that base. It's not until you get to Schedule R that you generally, I seem to take it out on side 1, but generally you're supposed to use side 1 or Schedule R to take out and separately handle non-business items. So in order to get something excluded from the measure of the base, there either needs to be a deduction, which in this case, we've discussed Zenith and the 24,410 dividend deduction, where there's generally an 85% allowed DRD dividend deduction. Or there's exempt interest income, but in the franchise tax, exempt interest income is included in the base. So you'll always see an addition on side one for exempt interest to add it back, because it is in the base. So usually we'll only see the DRDs as being subject to the 24 or 25 deduction. So in our case, unless you have an M1 adjustment or an M3 adjustment, removing it from book income, because it should be in book income, you need an M1 or an M3 to back it out, and remove it from the measured tax, or you would need a DRD, 24,410, to remove it from the measured tax. You don't have an item excluded from the measured tax. Instead, you go over to Schedule R. You have items that are removed, like cap gains and losses, which require separate handling. You add them back in when you're done. And you have allocable income that you have to remove from the base because you have to separately handle that as well. But then it comes back in if it's allocable to California or is left out, but it's not excluded from the measure of tax. It's included in the overall computations. And that's why there's a requirement and a need for 24,120D, or sorry, 25,120D to make those allocations of expenses that were in the base to get a clear reflection of the allocable income that should be separately handled.
Judge Bass, do you have any questions?
Sorry, it's complicated.
He's our CPA in the panel.
That's true. Are you gonna go over the schedules you provided, Exhibit 18, or is that, before I ask questions on that, I wasn't sure if I was.
We can discuss the schedules. I think the logical answer is that the numbers logically flow from the legal conclusions. The legal conclusions, one, we have separate trees of businesses for each of the partnerships that have been handled. And then we have the adjustments that reflect the interest issue at hand that the NTB has proposed. We've also taken out the like-kind exchange in 2006 and the NTB's already conceded. And then really it comes down to, once you get through the base, does the interest offset apply before you allocate the interest or after, which is what the NTB has argued that it's after. Our position is it's before, consistent with what you do with 24,344C. That adjustment is made before consideration of business or non-business treatment. On Schedule R, it's at the top of Schedule R, you make that adjustment first. And since these two code sections are in the same statute, there's no logical reason to treat them differently. And then it's an issue of how to allocate that interest expense, if it is required at all, how to allocate it between what's within California and without. We have proposed a methodology that's based on net income, because if you read through our protest, what it says is that in evaluating how much money to lend to the U.S. for purposes of investment, they looked at their ability to repay the loans, both on a cash flow basis for the interest expense itself and on its investments itself in the event principal needed to be repaid. So we believe using a cash flow income ability to repay the debts is consistent not only with how the money was borrowed, it's consistent with the flexibility in the statutes as well as the FTE's guidance in NEPM 4060.
Okay. So I gone through the numbers and it makes sense, what the schedules are trying to do. I have two questions. One is more of a technical one, and the other one is more where the numbers come from. I guess I'll start with more of the technical one. The interest offset was held unconstitutional, so why, in Hunt Weston, so why would the taxpayer be entitled to interest offset in this case?
So the FTB issued guidance, FTB Notice 2000-9, saying that for domestic, California entities, they would still apply the offset. And I had a copy of that if you need that.
Oh, it's okay, I'm aware of that. Maybe we'll come back to it.
Why don't you ask the
Okay.
Respondents' Council?
I actually would like to respond.
Okay, yeah, go ahead.
To a lot of it.
Yeah.
I'm not sure how this is a witness testimony when a witness here is really just putting together Felon's case. I'm not sure why, I've never seen a witness putting together substantive arguments. So I'm not sure how to even respond to this, and I'll treat it just as a reply, I guess.
No, well, I think the question that I'd like to ask, and I think Kenny was getting at, is why why does the FTB not applying notice 2000-9 here?
Because it does not apply here. 24.425 trumps 24.344, and both the Supreme Court states that, and the setup of the 24.425 does. But I would like to address something else that has been stated.
Or you'll be able to respond to her testimony through cross-examination in your closing argument.
Right, but her testimony seems to be really a re-argument of the case. It seems to be more of a substantive nature than factual nature.
You'll be able to re-argue your case in closing. And we'll also have some more questions where you'll be able to make your points.
Okay.
Judge, do you have more questions? So you have to walk through the computations?
Yeah, okay, then maybe we'll revisit interest offset. So for the percent of interest allocated,
Can you indicate which document you're looking at?
it's Exhibit 18, page 2, 197.
18.
All right, so
I have an extra copy.
it would appear that when we printed this off at work yesterday, we did not get page 2 through 96.
We have to, when we address the interest offset, we have to keep in consideration the fact that allocation of interest expense deduction pursuant to 24.425 has two considerations that we get a direction from both Zenith and Board of Appeals. Both consideration is when we allocate an interest expense deduction, we have to consider the purpose and the actual use of the loans. Here, the purpose and the actual use of the loans has no relations to the generation of interest income. If it does have a relation, meaning that if taxpayer's stipulation that it earns income solely from partnership income and does not have any other source of income other than its passive holdings, partnership holdings, then we don't need to allocate separately to interest income, because allocation based on Zenith would provide for allocation of loans based on purpose and use. So an interest, it seems to be a detour talking about interest offset as if the loans that we're talking about are related to generation of that income. It is not.
But in FTB's notice, don't you disregard the direct tracing initially? And if you have any business income, interest income, you get a direct offset regardless if you can directly trace it. Isn't that how the notice?
You said business income.
Business interest income, yeah.
We don't have, okay, so again, 24.425 defines what deductions are allowed. By going through notice or 24.344, you go around 24.425. That is not proper. You're first supposed to look at what deductions are allowable. 24.425 tells you what is not allowable. You first determine the allowable amount of deduction. Then you allocate it. How you want on your return. You want to set your interest expense first, that's fine. What the appellant is trying to do here, they want to ignore the existence of 24.425. Allocate it first, which means take a big chunk of the expense against the interest income, to which that interest expense is not even related to, based on the purpose of the loans that we have in Exhibit B. It's stipulated and it's admitted as evidence. What they want to do is they want to somehow ignore the 24.425 disallowance, and first allow a big chunk against interest income, and only then allocate. Well, this is not what the 24.425 stands for, and this is not what the California Supreme Court decision stands for. What it stands for is you first determine what deduction, what portion of deduction is allowable, and then you offset or do anything else you have to do with that allowable amount. To determine that allowable amount, you first have to see how was that expense generated. By, how? You borrowed to generate the expense, fine, but did you borrow what for? What's the purpose of the loan? The purpose of the loan here, we know, to invest in the real estate properties on behalf of the BBC Trust.
So this is why notice 2000-9 in your view doesn't apply.
It does not apply. Okay. It does not apply to subvert 24.425. It does not trump 24.425.
revenue and taxation code 24425 trumps all considerations that has to do with 24344. It just follows it, it does not precede it. 24344 does not precede 24425 for purposes of determining allowable deduction.
So my next question is, and I'm not trying to be, I'm just trying to understand how all these interest provisions work, or expense disallowance provisions work. Does your interpretation of 24425 render the interest offset 25120D, even 25137-1D, is that all that surplusage now because you just have 24425 and that's it?
In this situation, in this specific situation, where we don't have apportionable business income, where we only have income from separate traded business, allocated, well, sourced specifically to a single state, yes, we go to 24425 first. In this specific situation, that's the only way we can go about it. There's no unity between the partner and the partnership, there's no unity between the partnerships itself. We don't need to even get there. What we have to determine is you have an expense, let's match it to the income that produced that expense was used to produce, and after that, let's allocate that expense based on how you used it to generate income. And that's simply a matching principle. And for California purposes, even though a appellant here said, well, you know, we excluded it as a non-business income, they excluded it because they have to source it to the location of the real estate, to the state. They excluded the income from partnerships owning interest in real estate outside of California because they have to. They have to do it, and Appeal of Holloway states specifically, without the consideration, without the unitary business there, or an activity that generates income both within and without, you just simply source it to the situs. You don't have to go through business, non-business. It just doesn't have any application here. So saying that California investment income is business income, but New York investment income is non-business income simply makes no sense. It's just income from separate traded business that is sourced to the situs of the investment.
Okay. Thank you. Should I continue?
Yes, please.
Okay. So, Ms. Friedman, on the schedules you provided, Exhibit 18.
Okay. And I don't mean to interrupt, but I think an evidentiary clarification is needed here. Exhibits 15, 16, and 17 were drafts, and now Exhibit 18, pages 2, 3, and 4 are the actual document that I think the appellant believes is the correct document. So without springing this on them, I don't think 15, 16, and 17 even need to be admitted as evidence, because I believe Exhibit 18, pages 2, 3, and 4 are the documents they want admitted. Is that?
That's correct. We did update the schedules to add a couple additional iterations of the same schedules.
Okay.
I'm sorry about that.
Okay. So I'm able to trace the numbers, you know, going through this. The one main question I had was, other than the 28% in scenario 1, that seems to come from the FTBs, 27.6%, just a rounding thing. Okay. Where did the other percentages come from, and why were the K1s provided? How does that help us with that?
So the K1s were provided as evidence in support of the numbers themselves, the taxable income bifurcations between the partnerships. And then the percentages proposed for 1A, those were the revised percentages that the FTB provided using investments, I believe, on the financial statements.
I can address it because it's our percentages.
Yeah.
We came to those percentages.
Which scenario?
Scenario 1A.
Oh, okay, those are you, okay.
Yes, the percentages are ours, and it's based on direct application of Revenue Procedure 7218, and it takes into consideration average adjusted basis of investments over total investments. So I can go to that formula and explain how it works and why it actually benefits the taxpayer once you have that question.
I think I'm okay with for that on that piece for now. Just trying to understand what the
And
percentages
Exhibit
are.
F, our Exhibit F shows exactly how we arrived at those percentages.
Exhibit F?
Exhibit F provides, provides how this percentage will calculate.
Okay, so then moving on to scenario 2. Okay, we got 28% there, okay, and then 2A, is that the same as 1A?
Yeah, so the original numbers that we had discussed prior to getting into the detail before the hearing, they had proposed initially this 28%, refined as 27.6%. And then during these discussions, they provide a new iteration of percentages as she discussed. So we wanted to show what they originally proposed and what's proposing now. And then our numbers, as far as the percentages, have remained unchanged, and those are in exhibits 3 and 4. Yeah.
I just need to make a correction. We didn't propose those percentages during the discussion because we were conceding issues, and we explained to the taxpayer during concession that certain tax consequences would follow, and that even if we agreed to the debt issue, debt versus equity issue, there would not be a full allowance of deduction. And taxpayer said, well, what do you mean it wouldn't be a full deduction? Then we explained, well, you know, without even going through financial statements and looking at how we should allocate this, just simply looking at cost basis, look, you only used about 28% of your loans to invest in California and produce California income. So at the most, you can use 28%, you know, just taking, it was not one of those situations where we said, you know, we'll give you 28%. It was not our consideration. It was simply for illustration purposes to explain that your tax consequences taking into consideration simply original basis would be something like that.
So your position is in scenario, the percentage?
1A.
Oh, sorry, what was
Our
that?
position is scenario 1A.
1A, okay, okay. Okay, and then scenario 3, now these are the taxpayers' percentages.
Right.
Okay. And where do those percentages come from? What are they telling us? Is that an income allocation, a partnership, or what is that telling us?
So what our methodology is that if you look back to the protest event, it says that in evaluating making the loans, they use the ability to repay the lending, because none of the debt was tied to any particular investment. The money was loaned to the company, and then they could choose the investments themselves. So there's no secured debt here. It's all that. It has been refinanced. Some of it's been repaid. Some of the properties have been resold, and the money is sitting in an account to make future investments, so that the money has changed. And there's been a like-kind exchange, so some of the basis is reflecting, you know, carryover basis instead of what the actual cost of the investment was. So in light of the fact that the money was borrowed on the premise of the ability to repay, we went back and looked at the ability to repay the debt as the grounds, so the net income from the partnerships over total net income from the partnerships before tax. So we're just using taxable income from the partnerships on the ability to repay. So that's where the percentages come from.
Can I?
You're including capital gains in that computation as well as rental income?
Yes, yes, all income. The question was the ability to repay, and that's how we would decide how the money was being borrowed. That's basically the basis for repayment, and that's how we allocated the interest expense using 25-120D, not 24-425.
If I would like to.
Yes, Ms. Kender.
I hear Ellen keep on saying ability to repay, and that's how the loans were given. The whole difficulty of this case is based on a factual, the difficulty of determining whether these advances were loans or contributions is still there. We simply agreed to honor the form. It was never, if you look at all the facts in the case, there is never an ability to pay as a consideration. Appellant was set up simply as a holding company of a pension trust that has to diversify its investments. It's a UK pension trust. It has to diversify investments in order to be a sound to have a sound investment property. It wants to invest in US real estate. It has a partner that is a UK company that is a very well-known in UK real estate investor.
a private company that does it for the last 300-400 years, that investor picks properties for the UK pension trust and invests with the US entity for the foreign purposes. So it's not as if they formed an entity, right? The entity is 100% owned by the UK pension trust. They don't have creditworthiness or anything else without being fully first funded by the pension trust. There's absolutely no evidence of creditworthiness evaluation or any of that. The sole purpose of the appellant was simply to accept money from the pension trust and to invest it into the properties that Grosvenor selected. Okay? There's absolutely no creditworthiness issue. They keep on saying that because with time, BBCAP, appellant, has accumulated a portfolio of investments, but that portfolio of investments it holds on behalf of BBCAP, on behalf of BBC Pension Trust in UK. So the whole difficulty of determining whether this was loans or contributions was when you look at the substance of the transaction. It's not, that doesn't, you don't see very often a one-page promissory note signed only by a subsidiary for $156 million. You just don't see that. Usually there's agreements, there's authorization, there's all of that. But here it was not necessary because all of these investments were still directly owned by the pension trust through the appellants. So saying that creditworthiness...
I just want to make it clear that, I mean, right now, you're making a lot of allegations that, I mean, we can take this in as argument, but there's no testimony or evidence about a lot of what you're saying right now in terms of the activities of how this company decided to operate. And
there is. It's in their opening brief. It has been stipulated.
That's argument. That's not evidence.
It's facts that appellant has provided in its opening brief in order for the respondent to change his position as to unity.
Well, to the extent that it's in the opening brief, we will consider them as admissions. But,
thank you.
Mr. Bass, do you have?
No, I think that's all my questions.
Okay. I just have a question just for Ms. Iskander. When were these figures, the percentages that varied by year, when were they first communicated to the taxpayer?
It was communicated.
We first saw them in, I think, your pretty recent brief. I think your last brief.
It was communicated in the reply brief.
And was it provided to the taxpayers before that?
Whether or not we did the allocation, we never agreed to an allocation. Taxpayers' position has always been that they're entitled to 100% of the deduction. So our reply brief was to set up, to explain that no, they are not entitled to 100%, and this is how it should be calculated.
Okay, so the first time you laid out these varying percentages by year was in your reply brief?
We did, I think so, yes. The reply brief, correct.
Is that correct, Ms. Freeman?
They had communicated originally it was 28%. And then we had provided the schedule showing what we thought was the correct computation because there were errors in the audit schedules that we corrected. And then the most recent provision of these revised numbers was when I was in Hawaii, which was the week of May 4th, when we saw the revised numbers.
Which was before the most recent numbers of May 4th.
Yeah, with the varying numbers, because before it was just 28%. The revised numbers in 1A, those we got the week, I think it was in Hawaii. It was the week of May 4th.
Okay.
That's the first time we saw these revised numbers.
Sure, take a moment.
I think if from numbers from them, they may have given us a reply brief itself.
Okay, and when did you first communicate your income portion numbers to the FTB? Was that first communicated in your brief or before that?
We believe we gave them numbers originally under their theory, but using 25120D, probably 2018.
Okay. And Ms. Freeman, didn't some of the pass-through entities hold multiple properties in multiple states?
Could you repeat the question?
Didn't some of the pass-through entities hold multiple properties?
I thought they were primarily one per partnership.
Okay.
They usually listed an address on the partnership.
Right, I mean, certainly each property interest was held in its own separate entity, whether it was as tenants, as a partner, a partnership, or a member in an LLC. I don't know offhand.
I'm looking at Exhibit C, page 7 of 7. Maybe they are.
There may, it is possible that there are multiple properties owned in a particular state. I just don't.
I'm not sure. Okay.
Yeah, I don't recall.
Okay, thank you. Judge Nowlan, you have a question?
Yeah, I have several for Ms. Freeman, and I'm gonna take you back some, and I think Mr. Kaplan gave his introduction, but a little bit more clear about what your role here was. Were you on the audit team in response to FTB's audit? Were you present there, or what was exactly your role?
So I got involved during the appeal, maybe late in the protest process for the original years. I was involved in the subsequent audit for the subsequent years and assisted with, including the initial audit meeting for the subsequent years.
And you're familiar with this particular taxpayer, the way they filed the returns during the audit years, during the current audit, and even prior years? Is that correct?
I've seen the tax returns, and I did not help prepare them, but I've seen them during the protest and appeal process.
Okay, so prior to 2005, was this, when they were filing as a unitary group, was the distributed shares of these non-California pass-through entities, were they classified as business or non-business income?
My understanding is they treated it as a unitary business in the prior years and determined during the current years that it was, should have been treated as separate trades or businesses for each of the partnerships.
But that wasn't my question. During the prior years, was this income from non-California pass-through entities treated as business or non-business income? If you're not, you don't remember, then that's fine.
From reading the protest itself and the appeal, it does indicate in there that in the prior years they had treated it as unitary business. I have not personally seen those returns.
Okay. As far as interest expense deductions are concerned for prior years, prior to 2005, were there any interest expense deductions taken on this $156 million loan on the returns?
My understanding is line 18 would have reflected the interest expense from the loans. It wasn't, there's no change on it, is my understanding.
Okay, so that would have been part of the federal tax base and there would be no further California adjustments?
Yeah.
So we flash forward to current year. So from what you're telling me, on the prior years, the interest expense was wholly deducted because there's no California adjustment and those interest expenses were allowed under the federal Internal Revenue Code. So on the current years 05 through 09, you want to use that same methodology to allow the federal computation to flow through without any other California adjustments. Is that correct?
On the return is filed, there were no state adjustments to allocate interest near 25-122.
Okay. Should there be?
In my opinion,
Yes.
had it been timely raised, there should have been an allocation under 25-122. And my understanding is in subsequent years, we've rectified the situation.
Okay, so you're talking about the new issue.
Yeah.
So let's go back to Ms. Gander's opening statement where she indicates that in her exhibits A and I believe B, that was documentation they sent out to the taxpayer earlier on during the audit or protest, that there was some indication that interest expense allocation would be an issue. What is your response to that claim?
My issue is that issue was raised after the statute of limitations on appeal as a new issue. And it's not using the correct code section, it's using 24.425 when there's no income excluded from the measure of the base. And 25.120D should be the crux.
Well, regardless of whether their approach is correct or incorrect, is franchise tax law correct that their exhibits A and B indicated early on before the appeal that the interest expense allocation issue would be something to be discussed?
I'm not aware that it was brought up before the appeal was filed. My understanding is it was brought up during the discussions between when the appeal was filed in October of 2015 and when the brief, their brief was filed in December of 2016.
Okay.
Wait a second, what happened during that time period? That was the time period that the interest allocation issue was raised?
Yeah, my understanding is when we were in protest, the issue of the like-kind exchange was resolved, but the issue of debt versus equity and the issue of unitary business was not resolved at protest, which was the subject matter of the appeal. And after the appeal was filed, that's when the discussions came up and the concession was made on the unitary business issue and the debt versus equity issue, and the new issues was raised once they realized the auditor's adjustments were incorrect.
Okay, and I believe my final question, I promise. In franchise tax board's reply brief on pages 3 and 5, lines 16 and 11 respectively, they reference some sort of agreement reached with you or your taxpayer about the proper allocation of interest expense. Do you recall any such agreement or any such discussion? And if you do recall them, when did those discussions occur?
I personally would not have been involved in those discussions. That would have been likely maybe at Hamlin.
I would ask that same question to either Mr. Kaplan or Ms. Caldwell because they testified when she does testify. Mr. Kaplan?
My recollection is we certainly never agreed to any methodology of an allocation. We did discuss our whole, the series of discussions were all premised on the question of if in fact an allocation is required, how would we go about doing it? We did not agree that an allocation was required in this instance, and we obviously did not agree on what methodology would be used if we needed
So
to.
is there any documentation or evidence linking the FTB's concession to an agreement to allow them to raise this allocation issue? Mr. Kaplan? Was FTB's concession of the main issues, the originally raised issues, at all contingent upon the FTB being permitted or allowed to raise an allocation issue?
Certainly not. It was ever communicated to us.
So getting back to my original question, you mentioned there was some sort of discussion. What's the time frame? Post-appeal filing, during protest, between your opening brief and their opening brief? What's your recollection?
The very first time we heard about the question of interest allocation was after the filing of the taxpayer's appeal in this matter. After the filing of the appeal, both the issues of unitary and debt equity were being addressed. The initial discussions were only related to those issues. And then at some point in time, I do have notes, not with me here, receiving a phone call that or maybe it was an email, that the Franchise Tax Board was conceding the two main issues, but now had another question about deductibility of how much of the interest could be deducted for California purposes.
Ms. Kent, is Mr. Kaplan's recollection as to the approximate time of when the interest expense allocation issue was brought up accurate?
As soon as they filed the opening brief, and then the legal division received that opening brief, and I was assigned to that appeal. When I reviewed the issues and decided that, another attorney actually reviewed the debt versus equity issue, and as soon as that attorney decided that decided to side with the appellants for us to concede, we communicated that even though they would be allowed to take an interest expense deduction, that interest expense deduction would be limited. And we had extensive discussions about that, and we do have a record of that in the form of emails. I also believe I have an email stating specifically to the taxpayer that 28% was not something that we proposed, but it was something for illustration purposes only to inform taxpayer how this would look so that they know their rights and decide whether or not to appeal this issue further.
Thank you, Mrs. Kent. Thank you, Ms. Freeman. Thank you, Mr. Kaplan.
Mr. Freeman, what were the other partners in BBCAF? Who were the other partners in BBCAF besides the British Broadcasting Company Pension Fund?
No, pension fund is the sole owner of BBCAF. BBCAF makes investments with Grosvenor USA or Grosvenor, California, I don't remember which of the entities. And it makes it in tandem with Grosvenor, either as partners in partnership, members in an LLC, or as tenants in common. They generally, I don't know if this has always been the case, but certainly the vast majority, if not all, they are 50-50 owners. Grosvenor handles the management of the properties and essentially most of the financing.
Okay. And I guess there was an issue raised by you in your brief and commented on by Ms. Iskander in her opening statement about the fact that one of the properties was purchased before the first loan was made. So it's that's a little bit confusing about it. If we do look at where the money went to, it would seem that money could not be allocated to any particular property unless it was refinancing or something. Is there any indication as to, there's a statement in the record, in one of the exhibits, it was an IDR response where basically the person the representative for BBCAF says that this money came in and was used to purchase properties. But one property was purchased before the first loan.
I'm not certain that that's the case. I don't know it to be true or not true. This is the first time the question of whether...
I think it was mentioned in your brief about that.
Well, if it was, then my recollection is not as good as it should be.
I think that if there was property purchased without lending, then that would be an issue impacting potentially the calculation. Because should the properties that are not subject to the financing go into the allocation, or do you consider it all done when you go to all our assets? So and just remember, some of their assets have been sold and are sitting in cash, and nothing's been allocated to that. But the interest has been treated as California, 100% California.
Mr. Kaplan, it's on page 6 of your, I think it's your reply brief. So the first property was purchased in January 1, 1997, but the first loan wasn't made until October 29, 1998.
I will not back off of the statement contained in the brief. I stand reminded.
Ms. Iskander, how should we deal with that fact? The fact that, does that fact, which is apparently how would that be taken into account in your computations?
There are several ways to think about this problem. One way is when we use Revenue Procedure 7218
And I would be happy to walk through that formula to explain why it is really a reasonable long-term formula. When we take that, we consider circumstantial evidence, and then we don't pay attention to the actual link. All we do is we say, how much assets do you own during a given year in California versus all of your assets, and we assign based on that. So let's say the tax, that allows for flexibility for the taxpayer, and it also reflects the purpose and use. So we don't even have to say, well, how much did you spend on this property, or did this property was part of the loan, or did you finance it further? So long as the loans are maintained and not paid off. So for example, we know that in 2013 they paid off some of the loan, so the interest deduction would be smaller, but the percentage would still vary on the taxpayer's holdings of the investments. And it would be reflected the purpose and use of the loans, because since loans are still on the books and the interest expense is still generated, it will be prorated based on the formula. And again, I would be happy to walk through that formula to explain why it actually is beneficial to the taxpayer in the long run, and it's easy to administer for the FTB. However, if we don't go with 7218, then we have to pick and choose, and that becomes difficult. So for example, we know from the evidence from this page 6 of the brief that states that California property was purchased prior to the initial loan. So, BBC Pension Trust made a capital contribution, and that was purchased, and then there followed loans. We have an evidence in file that BBC Trust made a capital contribution, for example. So, if we do that, then we have a direct link for that specific property, which means no interest expense deduction would be assigned to that property. And then we are stuck in determining, so if we can't allocate anything to this California property, then what should we do? Should we consider income from that California property as repayments of the loan? Should we consider all other properties they purchased after, and basically bifurcating and evidentiary into direct and indirect, which makes it very messy. And that's exactly why Revenue Procedure 7218 formula is very helpful, because it treats the interest expense as either supported by direct link or supported by circumstantial evidence. In this case, we don't have a direct link to all of the properties, but we have sufficient circumstantial evidence suggesting that loans were used to purchase real estate in and out of California. And to allocate that interest expense is most reasonably and most easily to administer is to look at the average assets in California versus total assets.
Do you have any more questions, Tony, for them?
Yeah, not for Ms. but Ms. Cantor on this last point about Rep Proc 72-18. Now, that's the IRS's answer for IRC 265. So, is FTB's position that Revenue Tax Code 24425 is the California equivalent of IRC 265, or is there some other standalone Revenue Tax Code provision that conforms to IRC 265?
No, it is patterned. 24425 is patterned under the federal provision that you mentioned. But because we have different rules for income that is included and excluded for a measure of tax, the tax-exempt language that is used for federal purposes is not the same for California purposes. And that's why it uses excluded from measure of tax instead of using something like tax-exempt obligations.
Which would allow FTB to use that provision against non-interest type excludable exempt income, for instance, insurance company dividends.
Which would allow the tax respondent to use that formula in order to allocate expenses that are not matched with the income that is included in the measure of tax.
But in your discussion of flexibility, neither the franchise tax board nor the taxpayers nor this panel is bound to use Rep Proc 72-18, correct?
Well, Revenue Procedure 7218 was actually part of presidential appeal of Zenith case. That formula specifically was not applied in Court of Appeal decisions in the FTB that endorsed appeal of Zenith, but had there been need for circumstantial evidence in the appeal of Apple v. FTB, I'm pretty sure that they would turn to revenue procedure as well. So then it is binding unless this panel decides that it doesn't want to be bound by it or it's not presidential anymore. And Zenit, appeal of Zenit did discuss revenue procedure 7218, did apply and did state that it's the best solution in the long term. I also would like to just state for the clarification, as far as prior years when they filed unitary, the expense, the interest expense that they would have included in the return would have been apportioned as well. So it's not as if they would provide income based on unitary basis, but full of the interest. The interest expense would also be apportioned during the unitary years.
I'm going to ask that to your auditor, and she took the stand, I guess.
She will be taking this.
Any more questions for Ms. Freeman?
I have one statement regarding Red Rock, is that the securities themselves would never fluctuate in value. And so, you know, if you spent $100 million buying $100 million in securities, you knew how much you borrowed for a specific dollar amount. With respect to partnership investments, in this case, we've sold some, we've done like-kind exchange, we've don't reflect their fair value. The partnership itself, if I don't take distributions, the value is up. If I take distributions, the value goes down. Depending on depreciation methods and amortization can significantly affect the investment base, versus the income you're going to earn from real property is going to be fairly static. So,
well, yes, but your numbers go way up and down each year. Your percentage is based on the source of income. It goes up and down considerably.
Right, because we have sold stuff over the years, and the interest income's gone up and things like that. So there are reasons why there are some fluctuations, but currently 100% of the interest income is coming to California anyway. So like I said, we believe the offset applies, but we think our methodology is just as reasonable, actually more reasonable than the methodology proposed by the FTB and under 25-120D, which is the appropriate authority and actually applicable under 24-425. A reasonable method can be used. And the FTB has not disproved that our method is unreasonable.
Okay, let's move on to FTB witness. Would you like to call a witness?
Yes.
Mrs. Skinner, I'm sorry, did you want to cross-examine Ms. Freeman and additionally you were asking questions and speaking?
No, but again, like, I'm not sure, to be honest with you, because Ms. Freeman is making statements that are argumentative. I feel like I have to explain that it's not necessarily so, but I can't because she's a witness and she's supposed to. So I'm not sure whether I'm supposed to reply to things that are stated otherwise, or if I'm just supposed to let it go and this is admitted as a fact.
I think that you
so, for
had
example,
an opportunity to make your arguments. I mean, we could go on, if you want to respond to Ms. Freeman's most recent response, if you want to ask her specific questions, you're allowed to cross-examine her. And you'll be allowed to make your position and closing argument as well.
right, and I'll do that.
The Franchise Tax Board was requested at a pre-hearing conference to have the schedules that the taxpayer provided, and which are now Exhibit 18, pages 2 through 4, I believe, to review those schedules to make sure that they were mechanically accurate and tied to tax return information. And so I called Stan Elaine and Casella to testify, so.
Ms. Kuznetsov, please raise your right hand and repeat after me. I solemnly swear or affirm that the testimony I give today will be the truth, the whole truth, and nothing but the truth. Is that correct? Yes. Thank you. Please be seated.
you state your name for the record, please?
Elaine Smith,
And what is your position?
tax auditor, franchise tax for the state of California.
And were you asked by FTD staff to review the numbers shown on Exhibit 18?
Yes,
And did you do that?
yes.
And in response, did you find any numbers that were different than the amounts that you thought should be on that schedule?
Yes, so for 2005, the interest deducted 100%. The taxpayer's schedule shows $9,413,348. And that number does not agree with what we got in our schedule, which is $10,037,194.
So you re-prepared that schedule, and that is Exhibit I?
That's correct.
And on Exhibit I, which amount did you use? For Schedule 1A on Exhibit I, or Scenario 1A on Exhibit I, which amount did you use?
The amount that I used was $10,037,194.
And where did that amount come from?
That amount came from the originally reported California tax return.
And as a result of changing that amount on 1A, what other changes to Schedule 1A occurred?
So as a result, we have a different interest, additional interest allocated to California, and then also the amount of tax due.
And for Scenario 2A, what changes did you make? Comparing our Exhibit I to the taxpayer's Exhibit 19.
So for Scenario 2A, again, interest deducted, instead of $9,430,348 as provided in the taxpayer schedule, the amount that we have is $10,037,194. So that's the difference between the taxpayer schedule and our schedule.
And on Scenario 3 of Exhibit I as compared to Exhibit 19, what changes did you make?
So in Scenario 3, again, the difference between the taxpayer schedule and our schedule is the taxpayer schedule reflects the interest deducted of $9,113,348. And our schedule shows interest deducted of $10,037,194.
And on Scenario 4 of Exhibit I as compared to the taxpayer's Exhibit 19, what change did you make?
So in Scenario 4, the difference between our schedule and the taxpayer schedule is, again, the interest deducted of 100%, and so our schedule reflects the, as originally reported amount of interest deducted of $10,037,194, and the taxpayer schedule shows interest deducted of $9,413,348.
And in reviewing the taxpayer's schedule and preparing Exhibit I, did you review the mathematics or the mechanics or the arithmetic of the schedules?
Yes, I did.
And in your opinion, are they all correct?
Yes, they are.
Did you look at the propriety of whether or not the methodology was appropriate?
No, I have not looked at the methodology.
I have no further questions.
Mr. Kaplan, I just note that the one change she's made, which is the 2005 interest deduction amount, you seem to have the correct amount on Exhibit 15, but the amount that she claims is correct on Exhibit 15, somehow between Exhibit 15 and 18, that figure got changed. I'm not sure what the reason for it is.
I think the issue is whether it ties to the audit schedules versus the return. And I
think we're bound by the audit schedules, if that's the case. So the question is whether we should pull the number from the return or from the audit schedules.
Okay, maybe, Mr. Kaplan, maybe, did you pull this $10 million figure from the audit schedules or from the return?
From the return, from the original tax return.
Okay. Mr. Kaplan, do you have any cross-examination?
A couple of minor questions. Did you compare the interest expense deduction number to the numbers used on the notice of proposed assessment or notice of action with respect to 2005?
No, I did not compare because I don't have the notice of proposed assessment. I'm not sure which notice of proposed assessment we are referencing here to.
Nothing further? Ms. Kuznetsov, so you were not involved in, the interest allocation percentages at all?
No, not in the interest allocations.
Okay. So any of my colleagues have any questions?
I think we would
Sure.
concede to whatever number's right, but I think we're bound by the audit schedules if it's gonna increase tax.
Okay, you're dismissed as a witness, or? Ms. Iskander, I have a question. We have Exhibit F, which is, I believe your interest, is how you came up with your interest allocation
Yes. percentage.
Can you, tell us how that was done?
Yes. The formula that revenue procedure 7218 provides is the average, that formula is to first calculate excludable interest. So the formula is how much of the interest, what portion of the interest is excluded from a California return. So that's a starting point for that formula. And it's calculated by taking average out-of-state investments, because those investments produce excludable from California return. Average investments out of California and divide that by the total assets for the year. So the total assets for the year include both real estate investments and any other assets that taxpayer may have. So any cash or cash account, for example, or any other assets that respondent may have that has been separated, for example, from real property investments. So you can see the total assets per financial statement. So all of these numbers were pulled from respondent from account financial statements that are also attached as an exhibit, so they easily can be verified. If you take average, so total assets in financial statements, you can see that for 2004 is 271 million. For 2005, it's 283.8 million. You can see that, right? I would like to make sure that you guys follow and I don't just rant.
Okay.
Which part?
So I'm looking at Exhibit F, and I'm asked to explain how these numbers were calculated. This Exhibit F provides assets and their adjusted in their value as stated in the adjusted basis, actually, that's stated in the financial statements. So we first have California assets and a subtotal California investment line, which says 35 million, 43 million, 48 million. Do you see that line?
Wait, how far down the form? Do you need a copy? Do you have a copy of this form?
It's Exhibit F.
We can share. Mr. Kaplan, may I have it?
Yeah, that's the other one.
Is
For
this-
illustration purposes.
Okay, I see it now. It's the first line that's in red.
Okay, so we'll start over. Okay, the first line is interest expense deduction for Schedule F of the return. We can see that 2005, 2009, it lists the interest expense deduction, right? Then we have assets. per financial statements. The assets the value starts from 2004 and goes to 2009. At first, we have California investments, and those investments are subtotal as, for example, for 2004, it's 35,465,003. Do you see that? It's right after 306 Rodeo Drive.
Okay, this is right here.
Yes?
Yes.
Subtotal California investments. Then if we move further down, you see all the investments that are non-California investments, and it says subtotal out-of-state California investments. Yes, and we have 2009, 2004. Then it says total other investments, 244, you can see that, right? So this is the sum, 244 million, this is the sum of California investments and out-of-state investments. Now we see the line total assets for financial statements, that's 271. You can see that the total assets are greater than the sum of the real estate investments, right? So then we move to the formula. The formula takes into account average adjusted basis, which means it takes the beginning of the year and end of the year and averages for the purposes of calculating. And that is helpful because if in the beginning of the year, Appellant has one set of, their portfolio investment is it includes one set of investments, and the end of the year is different, then the average would reflect that, right? So an average out-of-state investment for the year, beginning and ending divided by 2, you see that line, right, is 207. Well, 207 million is an average of 209 million for 2004 out-of-state investments and 204 million for 2005. So the numerator of the formula is out-of-state investments averaged at their adjusted basis. And the denominator of that formula is the total assets, again averaged. If you take total assets for the 2004 and 2005, you average them, and that becomes 277 million. This is how you divide to out-of-state investment proportion compared to total assets, right? So you say 74.63% of the interest expense deduction should not be included in California return. So the remainder would be included in California return. I stated earlier that this calculation, first, do you have any questions so far? Okay. Earlier I stated that this calculation that revenue procedure provides is actually helpful to the taxpayer. And the reason it is helpful is because instead of first calculating California investments over total assets, it calculates out-of-state assets over total assets. And total assets usually are larger, so denominator is larger. For illustration purposes, and I think that would be more helpful than me just trying to prove it to you, I would like to provide you with, and this is not an exhibit, it's simply an illustration, that had the formula played.
Let's at least mark this. So be marked as exhibit J. Real estate. Go ahead.
Okay, so for illustration purposes, if we took, and I had to make a correction, you can see California in the formula, average California state's investments over total assets, right? That would give you would think, well, we could just do that and get straight a percentage of the includable interest expense. Well, that amounts to 14% instead of the 25% on our prior Schedule F. If you compare this number, the last number, allowed portion of interest expense on this Exhibit J, to the last number on Exhibit F, you will see that by using revenue procedure, taxpayer gets to deduct 25% of the expense against its income, California income, instead of 14%. And if you think about it, they only, based on average value, right, they only use 14%, but they get to deduct 25%, because the formula actually favors a deduction and gives taxpayer a better leverage.
Now, Mrs. Kendall, when you talk about adjusted basis of assets. Are you talking about assets in terms of the pass-through entity as the asset, or as the real estate itself as the asset, and other assets within that pass-through entity?
It's pass-through entity.
It's the value of the entity
It's the
itself.
value of the entity itself. So the distributions, for example, from the properties would reduce basis and contributions will increase basis. So it is the basis of the investments, not the basis of real property.
Well,
But
I'm not
the problem
talking
is,
about
that the problem is that the loan itself doesn't change based on how the adjusted basis, the assets, whether they go up or down. They're still the same, correct?
The loan does not change. The assignment of that loan changes based on average assets. And this is so because Revenue Procedure 7218 is only triggered when we try to approximate in the absence of direct claim.
Well, when you say the assignment, you mean the assignment of the interest expense, not the assignment of the loans.
The interest
Stay.
expense on those loans.
Okay.
okay. I'm trying to track this through to the financial statements, Mrs. Sander, and I see, for example, for 2009, you come up with well, we're looking at your Schedule F. For 2009, you come up with a figure for land freeholds, which is halfway down Exhibit F on the far right, of 43,083,062.
I'm sorry, I have to find where you're looking at it, financial statements, is that correct? You're trying to
Well, in a
verify the
second,
number?
I'm just trying to show you what you're comparing. Yeah, you can look at Exhibit G, page 120 of
Okay.
128.
Exhibit G, the new one. I'm looking at Exhibit G, correct?
Yes.
Okay,
That's J. G is.
I'm sorry.
G is.
G is financial statements, okay. And which page?
Page 120.
Okay, Exhibit G starts with page 128. You're looking at, I'm sorry, 120.
So,
Yes,
I see on the bottom row of page 120 of Exhibit G, the numbers that appear, I believe, on the right-hand side, on the rightmost column of Exhibit F for these partnerships. So this does track through from the financials, but
can you give
you...
me a second, please? Just a second.
Sure.
I'll have my auditor help me with the tracing of the numbers from financial statements. Okay, so I'm looking at page 120 of Exhibit G. And which property?
Well, all the properties, the bottom row, I believe, corresponds with the rightmost row of Exhibit F. So, for example, halfway down Exhibit F, you see in the rightmost column, you see a $43 million figure,
Yes,
and that's at the bottom of the first column of Exhibit G for Atlantic freeholds of their net assets.
yes.
I just don't, you say that you're comparing these assets, or using these assets to their adjusted basis, but I'm not so certain that the financial statements is based on their adjusted basis for tax purposes. I guess that's my question. Are you comparing apples and oranges here?
I don't think so. I'm looking at what they have here. I'm looking at the volume of their assets on a given year, during a given year and a given date.
Okay. Where do you get, okay, well so you're taking the numbers from this page. Where do you come up with which page of Exhibit G do you use to find out the total assets per financial statements? Are you just summing up these columns, or is there a separate entry on the?
No, the total
interest
assets, I believe, is in,
Judge Leong said this might have to do with some M1 and M3 adjustments. We'll ask, just figure it out in a second.
Can we take a 5-minute break?
Yes. Let's take a 5-minute break. I would like to have these figures kind of explain to me how you come up with them. And I kind of have some questions about.
okay,
This
so
is
I
gonna-
can tell you.
This is,
that-
we're gonna take a break, but when we get back, I'd like to kind of track through these numbers, and I have some questions about using deductions, withdrawals, and things, and making your computations and depreciation deductions, things like that.
I just would like to, are we done? I'm sorry, I
Yeah,
mean,
whatever.
we are not talking,
We're taking a
I'm
recess.
gonna talk later, right?
Yeah,
Okay.
we'll take a 5-minute recess.
Not now, later.
Yeah, I think it's about time.
Right, exactly, okay.
So let me ask you, volunteer, if you're gonna, you not the volunteer for it.
Nah, this is no volunteer, this is, well, it means it's volunteer, yeah, but. This is fine.
Yeah, okay, let me see. All right.
This is scanning or whenever you're ready. Take your time.
Okay,
Okay, we're back on the record.
so your last question was where the total assets come from?
Yes,
Okay, that's page 108
108
of the exhibit G.
of the G. Yes. Page 108. Third bottom corner.
One oh eight.
108.
So the total assets is 625 million. Okay.
Okay, I have a question then. If you look at the, page 120, the $43 million figure you're using for, let's say, Atlantic freeholds, that is net assets, assets plus liabilities, but it looks like the number you're comparing it to for the corporation is total assets. It doesn't take into account liabilities.
Well, if you look at, it seems that their presentation has changed in the later years, but the numbers may, you know, if you look at page 13, for example, of the same exhibit,
There's 13.
13.
Okay. Got it.
And you see their Atlantic freeholds balance at the end of the year.
Yes.
And it's 13,330,717 for the year 2005.
Right.
That number corresponds to Atlantic freehold for 2005 on the Schedule F.
Corresponds to what number?
Schedule F, Atlantic freeholds for 2005. I mean, Schedule F, the Exhibit F.
Exhibit F.
Right here. Oh. You changed years on me.
It seems
We're
that they
talking
have,
about
it seems that
2009.
their financial statements have different presentation, but the numbers that are reflected are actually a value at the end of the year. They just, it seems that they name it differently, but if you look at 2004, 2005,
Can we stick with 2009? We were talking about, we were at page 120 of 128 of Exhibit G. We had a $43 million, which was
Yes.
net. And then you said that on page, what was it, 108 of that exhibit, had the total assets. I just want to make sure that year tracks through. So, after you take out liabilities, I mean, if you take out liabilities for the parent company, like you do for the pass-through entities, it's only $384 million. I'm not.
what I'm
an
trying to
expert
say
at this.
here is that, well, I'm also an attorney, I'm also not an auditor. This schedules were put by an auditor, looking at the financial statements and taking into consideration the value of the assets based on financial assets, trying to apply the formula. Now, the formula applies equally to every property on that list, which means if we take net assets for one property, let's say located somewhere else, it will be the same amount of, the same calculation for the property in California. So it's not as if we treat different properties out of state differently from California real property. This is their financial statements. If you look at 2004, 2005, their presentation is reflective of adjusted basis of their investments. It seems that the presentation on page 120, they try to achieve the same presentation for financial statement purposes, but they do it in a different way. So again, if you trace those numbers to value of the assets, then you will find them in these schedules.
If you want me to explain to you why 43 number is the value of their asset, is because it says that this is the, because it says that this is the net asset value of that specific asset. And again, it's used across for all the properties. It's not as if one property is prejudiced against the other.
Okay, let me
So
ask
the
you one more
percentage-
question before I move to Ms. Freeman. You've been saying that you've been using the adjusted basis. I think you're not really using the adjusted basis for tax purposes in determining the values. I think you're using, financial statements seem to be using the fair value for financial reporting purposes. Is that correct?
That's possibly so, but the revenue procedure does not differentiate. It does not require for us to use tax basis or.
No, well, I was concerned because I thought you were using tax basis before.
We are using financial statements, and we made it clear that we use numbers from financial statements. And during our pre-hearing conference, I was specifically asked why I submitted financial statements, and I specifically responded because those support numbers in Exhibit F.
Okay. Ms. Freeman, can you explain or help shed some light on the FTE's computation? I know it's kind of weird to ask you to do this.
I understand. So the revenue procedure that they're talking about, 17-18, is dealing with securities, tax-exempt securities. Your basis is never going to change. So if I pay $100 million for the securities, and my debt is $100 million, it's static until I sell them, and obviously the basis is going to change because I've obviously.
I understand.
Yeah. Here you have a situation, and I think the one entity that you did pick is representative of our concerns over the reasonableness of their methodologies. You know, we started out with $156 million in debt. That didn't change. And we actually did pay down $35 million of it. So what you see here is, for example, in 2004 for Atlantic Freehold, you see an $11 million base. Let's just assume that is what they paid for it. You know, I don't know that it is. But you see over time that this out-of-state investment goes up to a $60 million investment when the loans haven't changed. So to use try to force a revenue procedure to apply to a type of asset it was never intended to apply to, in our opinion, is somewhat distorted and doesn't clearly reflect the base of the assets in question that were purchased with these with the funds in question. So, and it's not just that one asset. You now have say the 156 million continued on through, when did we finance 12? So for all these years, you have $156 million in debt, but you're looking at $822 million in assets, and you're not actually looking at the properties necessarily itself. It could be other assets sitting in the partnership as well, and undistributed, share the partnership income, and whether you choose to pull money out of a California investment or an out-of-state investment absolutely can impact this ratio, and it's sort of arbitrary in my opinion because of the nature of the asset. I don't think the rent farm reasonable means.
But if their method is conceptually correct, I guess my question is, are they, in your opinion, are they comparing fair value of individual assets versus fair value of total assets, or are they doing something else here?
My understanding.
For financial statement purposes, one of the principles is conservatives, being conservative, meaning with respect to assets, you either do cost, or the only way you do value is if value has shown to be over a period of time lower than cost. So what's in the financial statements is predominantly not going to be value, it's going to be the cost of the asset. Again, unless there's been a write-down to value because the value is less than the cost.
Okay, Ms. Freeman, thank you. Mr. Susan.
So for partnership investments, they actually are adjusted for earnings and distributions and other contributions you made, which may not have been funded through. So there can be things in those investments for financial statement and tax purposes that are not reflective of the debt itself. So that's just
Mr. Vance, do you have any questions?
No questions.
Judge Now?
Can I add a few points?
You may.
Revenue procedure addresses portfolio investments that may include investment in real estate. That's one thing to consider, which means that real estate would be subject to revenue procedure 7218 allocation.
You said the 7218 mentions real estate
Mentions
assets.
portfolio investments, including investments in real estate, yes. And next, what revenue procedure does, it does not exactly match, because the exact match can only be done if taxpayer provides a direct link between the loan and the asset. Here, we don't have that fact, so we have to rely on circumstantial evidence. And revenue procedure is an approximation. What it does, it approximates holdings. When holdings vary, the percentage vary. When you look at revenue procedure 7218 percentages, you can see that they tag along within the same range. They don't spike into 100% or 50% or 0. They reflect the asset holdings during a given year based on their financial statements, which we were just told is at cost. So revenue procedure is actually closer to even original basis, consistently closer than, for example, relying on income. And revenue procedure also traces traces the purpose and the use of the loans, exactly what the Court of Appeals told us we should be using when we allocate interest expense deduction.
Mr. Kaplan, since I gave Ms. Iskander a moment, would you like to say something further before we go to closing arguments?
No.
Thank you. Okay, are parties ready for closing arguments? Mr. Kaplan, you have 10 minutes for your closing argument.
All right, I hope not to take that long. First and foremost, the issue we've been discussing primarily today, one of interest allocation, is 100% of the interest expense paid by the taxpayer deductible against its California income, was readily apparent on the tax returns that the taxpayer filed. 100% of the interest income was deducted on those returns. The returns were audited over a period of years, another 4 years at the protest level. No one ever mentioned an issue with respect to the allocation of the interest expense. It was raised for the first time after this appeal was filed. With respect to the debt equity issue, some of what I heard sounded to me like the Franchise Tax Board was trying to back off on its concession of the debt equity issue by saying that the ability to repay the debt was not really a concern of the taxpayer's parent. It owned the properties one way or the other. But in my experience, and in my analysis of any issue involving a distinction between debt and equity, the ability to pay is a fundamental element of any determination of whether or not there is truly a debt involved. The ability to pay is not something that is insignificant. The Franchise Tax Board, in making its determination that it did have debt here and not equity investments, presumably took that into account, and I do not think they should be able to back off of that conclusion at this point. Franchise Tax Board continues to push for Revenue Procedure 7218 as providing a methodology to be used for the allocation. Taxpayer continues to believe that that revenue procedure is irrelevant and that it did not have any tax-exempt income that would trigger its relevance. Franchise Tax Board mentioned the appeal of Signal is establishing that 24344 trumps all other allocation methodologies, but as Judge Leung noted, neither party is bound to use it. It's not a statutorily required methodology. And two, if it does trump other methodologies, it's in the context of exempt income. Again, taxpayer simply doesn't have any. Taxpayer believes that UDIPTA does apply. We've got partnership income from within and without California. 25137-1 applies to treat each partnership as a separate trade or business. 25120D should be applied to allocate expenses, not section 24425. We believe that the statute of limitations expired at the time the notices of proposed assessment were issued. This issue was not raised prior to that time. We believe the statute prevents it from being raised today. The interest income reported by the taxpayer in some years was relatively significant, $1, $2+ million. All of that is reported on its California returns as originally filed. The interest expense, the Franchise Tax Board would like to allocate to other states and not allow the taxpayer to deduct it against their California income. But it does not seem to have a problem with including all of the interest income that it earned on its California tax base. I think that again, if we get past the statute of limitations issue, if the Franchise Tax Board is allowed to pursue this issue and this panel wants to consider it, and if ultimately this panel determines that there is a tax liability owing from the taxpayer during one or more of these years, we believe that the interest abatement provisions apply, or the interest suspension provisions rather apply, and interest should not accrue on any such deficiencies, at least from the 18 months following the filing of the return through the time the taxpayer was notified for the first time of this issue. I want to thank the panel for its not only its patience, but its ability to delve deeply into complex computational matters, something which is somewhat beyond me, which again is why I brought Ms. Freeman with me. And we hope if the panel has any remaining questions, we can do our best to answer them.
Thank you very much. I did have one question about something you said about, you said the interest income was significant and it was reported on the California returns, and then you made an argument that the FTB didn't have any problem requiring you to include 100% of that income. Could you just explain what you meant there? I didn't quite follow.
Well, it seems to me, I mean, in our mind, the interest income and the interest expense offset. It's the monies that the taxpayer has essentially are all originating from its sole shareholder. It makes investments, it receives distributions, whether it returns money to its shareholder at that point in time or invests it on a short-term basis. It has interest income. If the interest expense is being allocated to out-of-state investments, it would seem logical to me, not to pursue this all the way through, but it would seem logical to me that a portion of the interest expense, or the interest income, would also be allocated outside of California. It's not an issue that we have ever pursued or discussed, and it would be too ironic for me to try to raise a new issue on that right now, so I won't do so.
Okay, thank you, Mr. Johnson. Any further questions for Mr. Kaplan? Ms. Scanlon.
This appeal involves up
after the concessions that respondent has made, this appeal really involves a tax consequence that follows the concession on classification of bonds as either debt or contributions. Because FTB changed its classification based on the same facts, the tax consequences require certain steps to be taken. Those steps are, we have to determine which portion of the allowed interest expense is deductible, and for that we turn to 24.425, a specific provision that specifically provides that expenses not attributable to assets generating income excluded from California tax base is not deductible against California income, because otherwise it would result in double deduction. The issue, again, FTB argues that the issue is not new because it's consequential. It has not been raised. The allocation issue has not been raised during audit or protest because the interest deduction was, the interest expense was denied in full because of the classification. Neither auditor nor a protest officer had to consider alternatives because what they had to do is issue notice of proposed assessment and notice of action, whether or not they agree with audit, for example, at the protest level. So alternatives do not enter notices. Notices have to be based on a position that respondent takes. Respondent took a position that interest expense is fully disallowed because the funds were considered during audit and protest to be contributions, not loans. During appeal, appellant reconsidered and agreed to honor the form, ignoring few of the wrinkles in the substance. And based on that, the tax consequences follow. That those tax consequences include first, the way we allocate, the way we calculate the allowable interest expense, and second, how do we do that? Again, respondent has used a precedential opinion in the appeal of Zenith, the Board of Equalization opinion that this panel is bound by its own rule, 30504, I believe. And also California Court of Appeals endorsed Zenith and stated specifically that unless the taxpayer can directly link the loans to the assets that produce income, the respondent's formula is reasonable and should be used. Now, going through a few of these things, 25120D, it seems that appellant here would like the UDITPA be triggered so that they can rely on 25120D proration. That proration is in the regulation 25120D and specifically covers allowable deduction. Well, even if we ignore the fact that UDITPA provisions don't apply and we went to California regulation 25120D, because that regulation covers allowable deduction, we would only be talking about the portion that is allowed. A disallowed portion, calculated under 24425, would not even enter that proration. So again, once we calculate the allowable deduction under 24425, and appeal is then endorsed by California Appellate Court in Apple v. FTB, then we can maybe move to 25120D using that portion that is allowed. As far as an interest offset, again, as already stated, Revenue Taxation Code 24425 trumps 24344 because the former specifically disallows the deduction. Furthermore, to specifically allocate interest expense to interest income, both the appeal of Zenith and Apple Court of Appeals decision require that the allocation is based on the purpose and the use of the loans. But appellant did not illustrate that it borrowed funds in order to generate interest income it seeks to offset. Rather, it specifically stated that it borrowed the funds to facilitate UK trust investments in US real estate to produce rental income. Appellant also stated that its income comes solely from the interest in real estate held by pass-through entities. And taking into account appellant's own statements at face value, interest income recorded in California return either relates to the production of income by real estate interest funded by the money appellant borrowed, or it simply does not have any relationship to that interest income. Again, offsetting here would just fly against the precedent set by Appeal of Zenith and Apple, as well as Revenue and Taxation Code 24425. Now, the Revenue Procedure 7218 formula, we argue is reasonable. First, we didn't come up with it. IRS did, and we endorsed it because the Appeal of Zenith provided that after considering the formula, it found that formula to be working the best in the long run. And that's exactly what we're trying to do for the purposes of administration. We're trying to reach a solution that works in the long run, not just for these years. In the long run, if appellant continues to maintain the same loans they borrowed in order to keep those loans working for their real estate investments, then however they choose to construct their portfolio of real estate, it will be reflected in the ratio of their adjusted basis as provided by the formula that Revenue Procedure 7218 provides. Appellant's offered income-based allocation is inferior to respondent's proposed allocation formula. And its exhibits are showing, because some years may result in 100% deduction against California income only. And when that happens, suddenly Revenue and Tax Code 24425 is subverted by simply looking into income. And looking into income also forgets about underlying purpose of the loans and the actual use of them. For this reason, respondent argues that, one, the issue is not new and should not be precluded because it's merely a tax consequence of its reclassification based on available facts, not new facts. Not a single new fact was considered for that tax consequence to apply. Two, that interest offset would not reflect presidential law, the precedent in California law. Three, even if you did applies, 120D would still not allocate separately some additional to allowable deduction of expense to interest income. And to address taxpayers' argument about interest abatement, suspension is not allowed, is not something that is offered to corporations. Interest suspension can only be done with individuals. Corporations interest can sometimes be abated for corporations, but that would be done only if there is either ministerial error or managerial act. If taxpayer disagrees that there was not a ministerial or managerial act, then it has to show that FTB abused its discretion when determining not to abate the interest by exercising the discretion arbitrarily, capriciously, or without some basis of fact or law. In neither of its briefs, appellant provided basis for concluding that respondent abused his discretion not to abate the interest. As such, appellant's request that interest be abated should be denied, and respondent positions that only a limited amount of interest expense should be allowed against California income calculated under revenue procedure formula should be sustained. Thank you.
Thank you. Mr. Kaplan, you have 5 minutes.
I'll keep my final comments very, very brief. I think that again, the question of if the matter moves down that road to where this panel is trying to determine what an appropriate methodology would be, I would like to remind the panel that the requirement is that the methodology used be reasonable. It's not mandated by statute. We believe that the methodology we've advanced in the event that it is required is reasonable. We believe that whether there are rationales that make one party thinks this methodology is better, somebody else thinks the other methodology is better. The real question is the methodology used by the taxpayer reasonable? And we believe that if required to make such an allocation, that the allocation based on income produced by the properties is the most reasonable methodology possible, and is certainly not unreasonable.
Okay, thank you very much. If there's nothing further, I want to thank you, thank both sides for very ably briefing and arguing this case. It's very complicated even for us who've been practicing multi-state law for a long time. And we appreciate your participation and your cooperation with us and with each other in this process. We will meet to discuss the case in private and send you our decision within 100 days. We may come back to you and request additional input, in which case we will extend that date. I want to let you know that you have nothing akin to the IRS Rule 155 process, so when we come out with a decision, you both said that you think you can work out numbers, and if you have 30 days after our decision is done, it's final. You know, you could pay the tax and come back on a claim for refund, but you know, you can't, hopefully you can come and work out your numbers together if we do come up with something that has not exactly been briefed in your schedules. Hopefully you can work that out very quickly and get back to us in the context of the petition for a hearing or whatever. But with that, the record is now closed, and if there's nothing further, we are adjourned. Thank you very much.
Thank you. Thank you.
Oh, the earlier one.
The bid? Yes.